India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's midweek, Wednesday morning, and inching closer and closer to the election results. Markets, of course, showing signs of nerves like what we had yesterday, the selling off from the day's highest point and ending down on a day-on-day basis. We're coming to you from the CNBC-TV18 Motilal Oswal studios. Lots to track, lots to cover. I am Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, good morning. Good morning, Nigel.
Morning.
So some volatility, little bit of, resistance at the 23,000 mark, but nothing concerning. Just a little bit of trepidation ahead of the election results.
Well, that's right. And, I think a week or so ago, we were talking about NVIDIA's numbers and, they were good, but the stock has gone up considerably. I'll tell you what, post the numbers in the last 1 week, the stock is up another 15%.
Wow.
That's the kind of...
1,100 or...
It's more than $1,100 right now. Overnight, it was up close to around 7%. So that's clearly in a world of its own.
Absolutely. It goes through, I was reading something, it goes through phases. I mean, the new product which has come, Blackwell, which is the new sort of GPUs which they produce. I mean, it flatline saying, well, how much more can it grow? And then they come out with earnings and a new product and then goes up another $200. It flatlines and then goes up. So I don't know how long it'll continue for, but it's been an incredible ride over the last 2 years or so. Well, let's just talk about here and now, right? And what you need to know as we begin another trading session. And, I'll start with yesterday where we left off, not in a very good way. But again, I said this yesterday as well. Is there really something insightful to take away from yesterday's trading session, except the fact that it sold off from the day's high before 12 noon and then selling accelerated in the last hour? Not really. I mean, looking at yesterday, you can't make trading strategies or anything over the next couple of days, except to say that there is, of course, nerves in the market because one doesn't know till one knows, which is, of course, Saturday exit polls. And by the way, on Saturday's evening, you'll get the exit polls. That's the 1st of June, once the last phase of polling ends. Typically, the exit polls will tell you broadly the direction of the result in the right way. They underestimate the extent of the win, etc. But, they'll tell you... so Monday, essentially, is going to be a big day. And then, of course, Tuesday, you'll get the actual results. Now, I'll just come to two data points, which we've been talking about non-stop, which is, what FIs have been doing. And that's been the big incremental marginal impact to this market. They've been big sellers. In futures, they've been shorting. In cash market, they've been selling. And in index futures, they continue to add longs now. So they're net long about 47,400 contracts or so. This is as of yesterday's close. This is, a big change because they were short 2 lakh contracts 4 days back. On the cash market, and we've said this, the selling intensity has been going down. Yesterday, there were small sellers. There were small buyers, beg your pardon, very small. The big bulk of the heavy lifting has happened from DIIs and local institutions in that sense. Now, equities overnight ended, I would look at the NASDAQ more than the Dow. The NASDAQ was up about 0.6%, so I'd go with that. But, you look at the Dow and the NASDAQ, it would appear as a bit of a mixed picture. The US 10-year yield jumped 8 basis points. We are now back about 4.5%. Remember, the 2-year is already closer to 5%. You had a non-voting member of the Fed, that's the US Federal Reserve, who made some comments. This is Kashkari, who essentially said that many more months of positive inflation data would give me confidence that it's appropriate to dial back. So not yet exactly putting his neck out and saying, well, what we have is good enough for us to start cutting. Dollar index was flat, 104.7. Oil prices have moved up a little bit at about 84.5, 84.5 for dollars. But again, we're around the 100-day moving average and the Brent here. Now, just to look at the market levels, again, it remains a very tightly ranged kind of a market without any big breaks on either side. Supports for the Nifty will come in at the 40-hourly average, which is now at 22,817. Very close by, 70 points out, and we are there. 22,888 is where we left off yesterday. And then you look at the 22,700 levels broadly. So let's hope that doesn't come into play and these supports are held. Now, on the way up, of course, 23,110 is the immediate upside level. And beyond that, you look at fresh highs. Nifty Bank also posted a negative daily close. And Nifty Bank had been underperforming in the last couple of days. It did better than the Nifty. Here, the support comes in at 48,812 and pretty close to where we left off yesterday. And that's also the 40-hourly average. I think, volatility is the name of the game. There's going to be nerves and there's going to be sort of a little bit of nervousness as we go into election results. That's been, I think that's very, very reasonable to expect as well. So if you expect anything otherwise in terms of a big move, directional move before over the next couple of days, I think that would be foolhardy. GIFT Nifty will come up on your screen. I'll tell you at least the opening kind of levels this morning. I think we'll have that up in just a bit. Yeah.
So the GIFT Nifty, is indicating a fall of around 115 odd points.
Yeah.
So I think this morning there's a little bit of trepidation, right, that you can see on the screen. And there are a couple of reasons for that. Of course, the market has been facing hurdles at the 23,000 mark, so that's important. But let's look at the flow situation yesterday. There was large buying from domestic institutions, and that's something that continues. So we've got that relentless support from domestic institutions. Almost 3,300 crores of buying. But let's put that into perspective, because yesterday's FII and DII data includes 5 block deals worth 4,100 crores. So better to, just keep that in mind when you look at this large number as far as the DII data goes. Now, in the month of May so far, money has been pumped in thick and fast. So 45,000 crores has been put in from DIIs. So keep that in mind. The US markets were mixed, but the important bit is what happened in the NASDAQ. It topped 17,000 for the first time ever. And of course, we've had some really strong moves coming in from the likes of Nvidia. So that is a space to look at. Now, as I said, the Nifty is facing resistance at 23,000, but there are some stocks that you can watch out for. Hindalco, of course, will be in focus as the company looks to raise $1 billion from the Novelis listing on the NYSE, and now the pricing is also out, so more details on that coming up, but that will definitely be front and center today. Apart from that, we have 3 important numbers coming out. There's Tata Steel, there is Bata, there's also Mazgaon Dock, and Mazgaon Dock has had a dream run. So let's see how those numbers shape up. And then IRCTC will be also reacting to their numbers, which was a mixed bag actually this time around. The revenues went up fine, 20%, but the margins were under pressure, down 220 basis points. A couple of other stocks like Amara Raja Batteries, etc., also reported a good set of numbers. So keep your eye out on that. But largely, you'd have to say the market is facing a bit of heat at that, 23,000 mark. GIFT Nifty suggesting a lower start.
Well, that's right, and you have the Asian markets as well that are under some pressure with Brent crude prices spiking up. So global headwinds are there up against us today. But yesterday we ended virtually at the low point of the day, but it wasn't really selling that was intensifying. There was lack of buying ahead of a big event. The money flows seemed to have dried up a little bit, and that explains why the broader markets were under more pressure rather than the frontline names. So that's one pocket. We'll wait for a couple of sessions out, and then things will normalize once we get the election verdict out of the way. The Nifty Bank, that plays out the weekly expiry today, so that's going to be the swing factor. Yesterday it ended virtually at the low point of the day. What did the FIs do? They added 10,000 long contracts. They covered some shorts as well, and that's why now you have the long position that's moved to around 54% or thereabouts. So the swing factor yesterday was around 25,000 contracts, and if you pull up a chart, you'll see now the FIs are net long, and it's the highest net long that we have seen all the way since April 2024. So just keep that in mind. We were short. Then, in fact, we moved into net long, and now we're close to around 50,000 contracts on the net long side itself. What about the options data? 23,000 call, 23,100 call. Last few sessions, you've seen aggressive writing out here, and the premium has come down to around 80 and around 45. A couple of sessions ago, the premium on the 23,100 call was close to around 100 rupees, and also the 23,200 call was far higher. We're facing resistance at higher levels, and that's pretty clear. Last couple of sessions, we're going to around the 23,000, 23,100 odd mark and doing a U-turn from there. Even on the Nifty Bank, that 49,500, 49,600 odd mark seems to be a bit of a congestion zone. So going by the options data, going by the resistance points, let's get to the levels. The Nifty seems to be in this broad 500-point range, and I have been maintaining this for the last few sessions as well. On the downside, 22,700, which was a bit of a resistance when we were going up. That becomes a support on the upside, the 23,200 odd. The Nifty Bank is going to be crucial today because it plays out the weekly expiry. Resistance from where we did a U-turn a couple of sessions ago. Earlier, we had a bit of a resistance at this level, that's 48,700, which now becomes a bit of a support. And then the 20 DMA in terms of a reference point. Since it's a stock-specific market, the one thing that I'm looking at is Cummins. It comes out with its numbers today. The delivery volumes that we saw a couple of sessions ago was close to around 15 lakh shares or thereabouts. And that's the highest that we have seen in nearly around the last 7-8 months or thereabouts. So big delivery is what we're seeing. Yesterday the stock ended at a fresh 52-week high as well. And if you pull up the chart, you'll see that though the markets are under pressure, that one ended virtually at the high point of the day. So Cummins is a stock that I'll keep on my radar.
Okay, as always, thanks a lot for that. 42% higher in the last 3 months. Definitely a stock to look at. But let's get straight to individual ideas now. In the sense, let's get you some opinion. This is a big week for the market, and Mahesh Nandurkar of Jefferies says that domestic equity inflows during 2024 so far are a staggering $7 billion per month, which would be nearly 2 times the previous high and more than 3 times year on year as domestic investors position for strong election results. He says at near 20% of financial savings and with the predictable flows to equity at less than half, the risk of domestic flow reversal is rising. He also says potential regulatory action on derivatives could be a trigger. He adds FPIs would likely buy the dips, limiting the downside on the large caps.
Okay, well, we've got Vikash Kumar Jain of CLSA who's also weighing in. He says that from the F&O universe of 183 liquid stocks, they've identified 54 companies which are perceived as direct beneficiaries of PM Modi's policies. Half of these are PSUs. He says remarkably 90% of Modi stocks have beaten the Nifty in the election-focused rally over the past 6 months versus only 42% of other companies outperforming, and this may continue in the case of a strong election result. He says L&T, NTPC, NHPC, PFC, ONGC, IGL, MGL, Bharti, Indus Tower, Reliance are some of the preferred Modi stocks for CLSA analysts. However, he adds this narrow election theme-based rally may end in June or July, and they see banks as the best risk-reward India growth play in the second half of 2024.
Okay, let's also get you some money market views on the rupee. Kunal Sudhani of Shinhan Bank says Fed Reserve officials flood the news wires. Inflation concerns weigh on the dollar. But Minneapolis Fed President Kashkari's comments on rates did bolster the dollar. He adds the dollar index continues to find support at 104.1, while Brent crude saw some up move. For the dollar, INR 83.10 acts as a support, while 83.30 is a resistance.
Okay, all right. Well, those are reviews coming in on different asset classes at this point in time. All right. On bonds, we've got Neeraj Gambhir who weighs in. Bonds rallied after RBI approved transfer of 2.1 lakh crores as dividend to central government. Government securities auction also strong demand with the 15-year paper cutoff coming in better than market expectations. The 10-year G6 saw profit booking near 6.97 levels. They expect the 10-year benchmark bond to now trade between a range of 6.95% and 7.05% before the general election outcome early next week.
Well, we've got a lot of stock-specific action to track for you. We get to that in just a bit. For the time being, we run you through the list. We're looking at Hindalco, Amara Raja, Aditya Birla Fashion, RR Kabel, MedPlus Health, Aster DM, Campus Activewear, and NBCC. All of them will be reacting to positive news flow overnight, while we have PNB Housing Finance and IRCTC that will be reacting to negative news flow.
Okay, well, we got our first sort of voice on the show. John Stoltzfus is Managing Director and Chief Investment Strategist at Oppenheimer Asset Management. John, great to have you with us here back on the program. Good morning. Thanks very much for joining us. Prashant, this side. Markets here a little up, a little down, but nerves, of course, before the election results now, which are a couple of days away. But from a global arena, with what we've seen overnight, Fed's Kashkari talking about how he'd like to wait a few more months of data before he thinks it's appropriate to dial back on interest rates. Dollar sort of strengthening a little bit, yields up about 7-8 basis points in the 10-year. What do you make of it?
Well, thanks for having me on the show. Great to be here with you tonight in New York and the morning in India. Pardon me. It's been a long day. This is the 16th hour for me. Well, I must say it is related to the market. Coming into this year, the impression was the Fed had intimated that it planned to cut rates, or likely would, 3 times this year. We thought it would be likely to only cut 2 times at that time. And then the market thought that the Fed would cut something like 3 to 5 times. And I've even heard some people thought it would cut to 7 to 11 times. Quite frankly, I think the inflation rate is really what you need to look at. We've got sticky inflation here stateside. The Fed has now raised rates 11 times and done 7 pauses at the highest level that when it stopped raising rates on the 11th hike. So that's 18 different meetings, and effectively they have not pushed the U.S. economy into a recession. It would appear to us that the Fed has really thus far accomplished a remarkable thing in that it has brought down inflation. In 2022, we were at 40-year highs. Inflation was almost 10%, about 9.6, I thought, thinking back then. And now we have inflation running at about 3.4%. If you look at the various indices on inflation, maybe 3.2. The idea to get to 2% is going to be tough because what you've seen is we have resilience in jobs creation. We have resilience within the consumer and resilience in business. Just looking at the earnings for the S&P 500 earnings, Q1 earnings season so far shows earnings up around 7.8%. Year over year on back of 4% revenue growth, with 8 sectors of the 11 showing positive earnings growth. And of those 8, you've got 6 showing double-digit earnings growth and only 3 sectors posting negative earnings growth. And among the sectors where you see the growth in earnings, it's mostly growth-oriented and cyclically oriented. So the Fed has its job ahead of it. But we think a lot of the drama that's being created out there, a lot of it is folks who really, when they look at this, they don't recognize the fact that we were at free money for a large part of the last 15 years because of the great financial crisis, followed by the pandemic and the effort to get supply chain going. So essentially, we're not surprised. We think it just requires a little bit of patience and diversification to come through it.
Okay, John, hi, good morning. That's been a long day for you, 16 hours and counting. I think someone needs some rest. But thank you for being with us, irrespective of such a long day. You know, for the Indian viewer, right, what matters is whether he should top up his investments or stay cautious. How are global investors looking at India now? Because India has been a top favorite, but we've also had a steep run-up in the last 1 year. How are things looking now?
You know, related to India, I think that the global investor, particularly the U.S. global investor, is looking for great things coming from India in the years ahead, and beginning, it already has begun. I mean, years ago, we were working with ordinary shares and then primarily ETFs. And then we had ADRs on stocks from India. Now, what's happening is the diversification of the global supply chain away from one country's centricity that we've had for over 30 years and looking for an expansion of partners, I think is terrific for India. The prospects are fabulous. From our viewpoint, I think what we're looking for as U.S. investors, we're looking for increased preparation in terms of infrastructure, training of teams of people for new operations that will be brought to India. And if anything, we think India will be the new growth stock of the Asian theater.
Hi, John. Good morning, and appreciate you staying up late for us here in India. You know, the other problem, I think, from an India investor perspective is China seems to be coming back, or maybe not. How do you read the Chinese recovery? You know, we have some statements coming in from the IMF earlier today, and they have upped their growth guidance by close to around 40 basis points. Your view, is China recovering, and is that a risk to this entire Indian stock market recovery that we've seen?
I think the issues around China, some of it is related to policy, domestic fiscal policy and direction by the government of China. And the other effect really is China seemed to have wanted to rely less on the rest of the world. It just hasn't worked out too well with the problems they have in their real estate market that they're working to change, and the problems they have demographically in the country that are challenging. That said, I think China will continue to grow, but there's plenty of room for other partners now, because the key thematic, I think, here is the diversification of the global supply chain away from one country centricity. And we would expect it would be the beneficiaries will be, we've already seen that in many ways, India, Vietnam, Korea, and Japan also. On a global basis, it'll be both emerging and developed international countries. And other ones will be Mexico, Brazil, Chile, Peru. This is a broader participation of globalization. And China certainly is in a position today in terms of its capability of manufacturing, logistics, and technology to be a worthy competitor of everyone, but it just will no longer be one road. It won't be like they used to say, all roads would lead to Rome. For many years, in terms of the global supply chain, at least most roads led to China, and that centricity, we think, is being diversified, in part because COVID proved it was very impractical. It's got to be a multiplicity of partners to have a successful process of globalization. And I think China knows that itself.
Got it, John. We leave it at that. Thank you so much for joining us once again, and appreciate your time here on CNBC-TV18. That's Oppenheimer Asset Management with their view, but plenty of stocks to look at. Hindalco will, of course, top the chart. So more on that coming up on the other side with our list of top 10 stocks. Stay tuned. Good morning. Welcome to Bazaar Morning Call once again. You have the Nifty that is facing a bit of resistance at the 23,000 mark. So this morning as well, not looking like a good start, a bit tricky, but let's see how it goes. Our research team is standing by with CNBC-TV18's list of top 10 stocks for the day. And of course, the big one to focus on will be Hindalco and Novelis. Nisha is joining in to give us the latest on that. Nisha, over to you.
Thanks for that. Yes, the price band is out and so is the valuation. And as we had earlier reported, $1 billion is what the India-listed Hindalco, the parent company of Novelis, is seeking to really raise from this large monetization exercise from its US-based Novelis. Now, as per the amount and the other numbers that have been stated, it's $12.6 billion at the higher end of the price band, which is the valuation that they are looking to achieve. In terms of green shoe options included, the total fundraise could be about $1 billion. Without the green shoe option, it could be around $950 million as per the higher end of the price band, which is at $18 to $21 per share. Now, also to note will be that Hindalco will be left with 91.5% or 92.5% stake in Novelis after this IPO process is over. We know that it's a wholly owned subsidiary, 100% is owned by Hindalco. So in terms of impact, first of all, it's the largest and the first large US listing by an India-owned company, and in terms of monetization and SOTP valuation, again, has seen a slight positive movement with the valuation of Novelis in IPO, and the future fundraising ability of Hindalco also improves.
All right, thanks a lot for that, Nisha. You know, when this news first came out, that was in February odd, the stock was at around 520 rupees. So from there, the stock is up close to around 25% approximately. Some part of this good news has been, priced in. And also you've seen that aluminium prices have moved up. So the base, business that's here in India has got a bit of a bump up. So, from that 510 odd mark, it's seen a big recovery. Just a couple of points out here. Post-listing, there will be a holding company discount. So just keep that in mind. So that's why the stock may not run away. And point number 2 is the FI has close to around a fourth of the entire holding of Hindalco here. If they list Novelis, then some of the FIs will say, maybe, just maybe, we'll take direct exposure to Novelis itself. So Just 2 points I wanted to add on to what Nisha said, so keep that in mind as well. Stock opens up in the green, but it may not run away because of a couple of these factors. Let's go to Sudarshan. Sudarshan joins us to tell us about PNB Housing. Morning, Sudarshan.
Morning, Naija. So yesterday we saw block deals of like in 5 equities of more than rupees 4,000 crore, and today there is another block deal likely, and that's in PNB Housing. Two foreign portfolio investors, Asia Opportunities Mauritius and General Atlantic Singapore, are likely to sell 2.7% equity. Talking about the details of the book, size is of 500 crore. Floor price is seen at rupees 717 per share, which is a discount of 5% to yesterday's closing price. And as of March 2024, holding of General Atlantic Singapore was at 9.82% and Asia Opportunities Mauritius at 9.88%. The reason I'm going with red, because of two reasons. First, floor price is at a discount of 5% to closing price of yesterday. Second, Asia Opportunities Mauritius had bought 9.88% stake at a price of rupees 821 per share. Now it's likely selling at 717 per share, which is a discount of or like fall of almost 12%.
All right, so thanks very much for that. IRCTC is the next one we're looking at. Mangalam is here with details on this one. Mangalam, morning.
Good morning. So it was a mixed set that came in for IRCTC. What was good was that the revenue growth came in at around 20-odd%, but the margins of the company actually did see a bit of a compression. So as a result of which, we have seen margins for the entire segments of the company, all the segments come lower. So about 19.7% in terms of top line. The company's reported revenues of around 1,155 crores. The EBITDA actually has grown just about 11.5%. That implies that a margin compression of nearly 220 basis points. The key segment of the company, which is ticketing, internet ticketing, out there the revenues grew 16%, but the EBIT grew just about 5.5%, implying a margin decline of nearly 800 basis points. So I expect the stock to see a bit of a red at open today.
Okay, so that's on IRCTC, but plenty of other stocks in focus. Let's see how IRCTC opens up in trade today. Amara Raja Batteries is the other one that I'm looking at. Good set of numbers coming in, so I'm going with green over there. Strong top-line growth of 15% is what Amara Raja has seen this time. The margins are also quite stable, although the operating profit margins are flat at 14.5%. The gross margins have come in at 34.5%, which is a growth of 150 basis points year-on-year and 54 basis points quarter-on-quarter. So the street will definitely like that. And the profit growth is up almost 63%, coming in at 228 odd crores. But it's important to remember two things. One is that the stock has rallied quite a bit. In the last 6 months, the stock is up 80%. So maybe a lot of the good news is in the price. And the second is the stock is now higher than its average multiples it has traded at in the past. So it's currently trading at 18.5 times FY25 price to earnings ratio. So just keep that in mind. But numbers are good nevertheless, and going with green on the stock. But Upasana is joining in. She has AB Fashion and RR Kabul on her radar. Upasana, good morning.
First up is ABFRL. The company's losses have widened, but company has recorded a strong revenue growth and margins have also expanded sharply. The company has seen a revenue uptick of 18% on a YoY basis, and margins have seen an expansion of 170 basis points at 8.5% on a YoY basis. While the losses have widened from 194 crores to 266 crores on a YoY basis, and company says that currently in a weak demand environment, management is focusing on improving its profitability. It has also said that consumption has continued to remain sluggish in the past 6 to 8 quarters, and company's net debt currently stands at 2,862 crores, meeting its FY24 debt guidance. The next up is RR Kabul. The revenue has seen a strong uptick of 16% on a YoY basis, which was mainly led by the company's main segment, that is wires and cables. Coming to wires and cables, the company recorded a revenue of 14% on a YoY basis, and margins saw an uptick of 50 basis points at 8.7%. In terms of revenue mix, wires and cables contribute 87%, and loss-making FMEG contributes about 17% of the overall revenue mix. The company's consolidated EBITDA margin stands flat at 6.6% versus 6.7% on a YoY basis, and PAT has seen an uptick of 21% on a YoY basis. Hence, I expect both these stocks to open in green today.
Thanks a lot for that, Upasana. Well, let's hop across to Ekta. She's here to tell us about Aster DM and MedPlus Health. Ekta?
Morning. Well, I'll start with MedPlus. The revenue was up around 19%. The margins improved to 7.1% versus 6.5%. So there was a marginal improvement which took place, but still in single digits. Profit 33.4 crores increased. 1.1% increase in private label sales this quarter. So that was a bit of a dampener, but it has been the case in the past couple of quarters. But the diagnostic losses are reduced to 1.1 crores versus 3.4 crores Q on Q. So that is a positive. As to DM, revenue was higher. Remember, it's only the India business which is reported this quarter. 973 crores, margin 16.4%, which was better year on year. Loss of around 24 crores. The average occupied beds for FY24 was up 12%. The RPOP, which is average revenue per occupied bed, was up around 10%, which is also positive for FY24. I expect both these stocks to probably be in the green. Aster DM could be weighed down because of the reported net loss.
Right. Lisa, thanks very much for that. We'll, of course, have the management of MedPlus join us a little later to talk about the numbers as well. But back to Mangalam, Campus Activewear and NBCC in focus. Mangalam.
Well, Campus Activewear, the revenues grew by about 4.6%. One would say that it's a small revenue growth given their history of growth, but FY24 was a tough year for all the footwear companies. What was positive was that their EBITDA grew by 13%, implied a margin improvement, and the net profit also surged by about 42.8%. The companies renewed their focus on trade distribution, ASPs increased as well, and they repaid some debt. So see some green on Campus today after a big drubbing that the stock has seen already. NBCC, on the other hand, has reported a very good set of numbers. The revenues grew by about 43%. The EBITDA too grew by over 130%. Margins improved. And all of this was led by their PMC business, where the revenues came in near 3,700 crores versus 2,500 crores itself. So good numbers for NBCC. See bright green on that stock.
Okay, thanks a lot for that. Well, let's move on and get you a quick recap now of our top stocks. Stocks with positive news flow: Hindalco, Amara Raja, Aditya Birla Fashion, RR Kabel, MedPlus Health, Aster DM Healthcare, Campus Activewear and NBCC. While stocks with negative news flow: PNB Housing Finance and IRCTC. But let's also get a quick word on what's happening in the world of commodities this morning. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, I'm looking at the dollar, which is steadied ahead of the U.S. inflation data. I mean, that is going to be the big thing to watch out for the rest of this week now. And ahead of that, with the dollar strength, we're looking at a bit of profit taking that you can see across metals as a sector. So whether it's about gold, we have seen prices hold around that $2,355 an ounce there. The markets are also looking at the silver prices trading very close to 11-year highs. The physical silver buying for industrial use has been higher, and that's exactly what really has been supporting platinum as well, which is trading very close to its 13-month highs right now. Copper prices also gained up by 1.5% overnight. So metals as a sector continues to do well. What also is doing well is the crude oil price is now trading at a 4-week highs at $84 a barrel. Well, the U.S. summer demand season seems good. The renewed geopolitical unrest in Middle East also has added premium to prices. The street will also watch out for the U.S. inventory data today and the OPEC and allies meeting on 2nd of June. That is where the new direction would come in from.
All right, Manisha, thanks very much for that. So that's commodities and oil with a bit of a bump that we saw last night. We'll take a break. Deven Choksi of DR Choksi Finserv will join in with some stock-specific conversation on the other side. Stay with us.
Welcome back. Hope you're having a good morning. Well, we've listed on all the stocks for you. Let's get some fundamental analysis going as well. We have Deven Choksi, Managing Director at DR Choksi Finserv, who joins us on the show. Hi, Deven. Good morning. Always good to see you in. Well, plenty of stocks that will be reacting to news flow. Let's talk about the top one, Hindalco. Looking at unlocking some value in Novelis, which is good news. And the valuation that's coming out of there is a little higher than what the street was ascribing to it. The problem is now there'll be a holding company discount, and also the FIs have an alternate. The stock has already run up, Deven. How do you approach it closer to around the 680, 690 rupees?
And Nigel, good morning. Well, on one side, definitely, I think this particular move will result into a higher amount of balance sheet play for Hindalco in particular. I think the amount of money that they are raising around 7,500, 8,000 crores, I think, which is basically definitely going to help the balance sheet of Hindalco per se. Could help Hindalco in a way. Ultimately, I think from the point of view of not requirement of funding for Novartis A. At the same time, I think getting cash generated for the brownfield greenfield expansion out here in India per se. And there is the bandwidth per se, I think, from the point of view of taking for the debt. So that is all in positive. Maybe I think the shareholders may not get enough amount of level because of the discount that you mentioned about. But I would think that I think overall this particular push should act as a positive for the company. The commodity cycle in particular, I think, we remain distinctly positive. Both the aluminum as well as the copper cycle remains, I think, extremely positive. And that should give the opportunity for Hindalco to continue its march. Maybe in the recent times, the stock price is already adequately priced every event or every such kind of news. I would think that one will have to wait for corrections in the market to re-enter into the stock.
Okay, Devin, hi, good morning. What are your thoughts on these battery manufacturers? Both Exide and Amara Raja reported very good set of numbers, but the stocks have run up a lot. So at this price, are you cautious or do you think that the risk reward is still favorable?
Yeah, good morning, Samir. Well, I guess I think this is the story for most of the stocks. I think you have most of the companies have factored in the development, the news, the price, whatever is talked about. I think it's all fully discounting the developments. Yes, I think I do agree that Maharaja's working has come up really smart. And I believe that I think if this trend continues, then the momentum will follow for this company. However, in the recent times, the stock has done everything which it should have done. I think as far as I think the price outlook is concerned, I believe that, again, corrective markets would be the better times to buy into the stock. Current valuations are adequately pricing all the events or the possible growth in the working in the financial year 24-25.
Devin, hi, morning. You know, we have this CLSA note that we were talking about earlier, and we'll put out more details on this one, right? They're essentially, and I've been asking people who've been on the show, what is the best way to get exposure for continuity, which is the baseline for the market? I mean, you know, of course, upsets aside, no one can say. You know, which is the best pack? Is it PSUs? Is it CLSA has got a note out and they list out a bunch of companies, you know, L&T and PFC, a few others out there as well. Just that question to you, Devin. I mean, if one is looking ahead a little bit, a week from now, in terms of where the market will be and what should one do now, what would your advice be? This is near term, of course.
Yeah, Prashant, good morning. Well, I believe that I think the focus should be on the consumption and focus should be on the B2B space in which I think the manufacturing companies are positioned. Certainly, I think the likes of Larsen, the ABB Siemens, all of them have suggested that they have got a very healthy order book and next 3 to 5 year visibility is extremely strong. But most of the news are definitely priced in and I think the stocks are putting it at a premium. So in such situation, I think keeping an eye on these companies is more important because I think once the event of election and the results gets played out, and after that, whenever the corrections of any degree comes in the market, probably this manufacturing sector would be the one where we will remain more comfortable buying into the portfolio because we see a horizon of next 3 to 5 years. Now here, I think you can also go for the consumption space, wherein I think particularly in auto and auto ancillary, where we believe that I think these companies are likely to produce continuously better performance going forward again for 3 to 5 years. Each of the verticals within auto, be it I think the commercial vehicle vertical, be it farm equipment vertical, the passenger vehicle and the two-wheelers. In each one of them, I think we are seeing a steady to healthier growth continuing, particularly in commercial vehicle, where we are distinctly confident about I think the way forward. So maybe I think these kind of companies like of Tata Motors, Ashok Leyland, though they may have moved up recently, I would think that I think there may be relatively better opportunity to buy into the portfolios.
Okay. Devin, just stay on because we have a company joining us now, Responsive Industries. It is one of India's biggest players in the vinyl floor manufacturing space, and they cater to sectors like the Indian Railways, to the Vande Bharat project. So, you know, the numbers have improved quite a bit. I mean, in Q4, they reported a very strong set of numbers. Revenues jumped 21%, margins expanded to 23% from 17% year on year. In fact, the company expects to continue its status as a zero debt company. So this stock has also doubled from the 52-week lows. We have the company's CEO, Rishabh Agarwal, who's joining us now to talk more about that. Rishabh, hi, good morning, and thanks a lot for joining in, and congratulations on a strong set of numbers. Now, we do know that you do have, an exposure to some of these high growth sectors like Indian Railways, etc. But just tell us, what is the kind of growth rate that you are looking at in FY25, and where is the largest opportunity for you in terms of orders?
Good morning. Thank you. It's a pleasure to be here. So in terms of the growth rates and in terms of the results, railways has certainly played a large part of it. India continues to invest in its rail sector. Vande Bharat's a key partner for us. But apart from Vande Bharat, all the initiatives from the railways, Garib Rath, Vande Bharat, the bullet train project, all of these play into a key segment for us on the, the high-end resilient flooring. In addition to this, the growth sectors come in from domestic bus manufacturing. There is a big push for electronic buses. EV buses is, big push from the Indian government side. And a lot of the bus bodybuilders have very, full order books. And as a, consequence of that, we have pretty good order books going into the bus flooring, the bus vinyl flooring and things like this. In terms of the growth, sorry. Yeah.
No, just one follow-up question there. So you said railways and EV buses, right, are a big part of the order book for you. How much is the contribution from railways and from EV buses right now, and how much can you grow it to?
Right. So the contribution is about 25 to 30% is the contribution from these businesses. We can grow that a further of about 20-25% in the following year. And the rest of the revenues is coming from the confluence of the US-centered business, actually. It's being driven from exports. Because, we are at the intersection of the diversification away from China, being the leader in resilient flooring over 30 years, having the scale capacity and ability to produce the high-end floorings needed for the US marketplace, having distribution in place, and actually being able to meet the moment and meet the demand. So, from the Indian perspective, we've got the buses and the railways. From the export perspective, we've got the US business. And, we made a big foray into the residential business with the luxury vinyls, which is factored at close to $10 billion, actually, as we speak.
Okay, all right. Absolutely. Rishabh, hi, good morning. Good to see you on Bazaar, I think, for the first time. Prashant, this side. So margins, I'm just looking at it, and profitability as a result of the net level went up. I mean, it's a big step-up jump, 24 over 23. Can you briefly tell us what led to that? Because top line is kind of steady, right? 1,087 crores compared to about 973 in FY23. But margins and bottom line, big jump. So that is one. Second, railways you've been supplying for, I mean, it's not a business you've started now. I was looking at your investor presentation. You've been sort of long-time suppliers. So how has that changed? Is the volume has gone up quite a bit, or your profitability there has gone up because of some of these newer trains, etc. So just give us some sense, Rishabh, there.
Great question. So on the railway side, the railways has been focused on increasing the customer experience and improving the customer experience in a meaningful way. So the railways has transformed its mindset more from performance-driven materials and trying to get to international standards. As in previous years, cost was a bigger driver necessarily than being able to hit the really the benefit of the consumer experience. And this improvement of standards and this improvement of service leads to more technocentric and more performance-driven kind of products. And that's where, the margin, positive margin impact with the railway business has transformed in the last few years vis-a-vis the business that we were doing before. Now, in terms of the overall margin expansion, there's been a transformation in the mindset to do value-added items, right? So in the flooring scale, we are really focusing where the aesthetic performance, the performance on durability, on 100% waterproof, those kind of things. So even when we talk about the US sales and US market, what we are really talking about is developing product which is intended for the right kind of use. So, we are driving margins and driving the right product through the system. So to your point, the margins, the revenue has grown up, ticked up by about 11-12%. But the real impact has been on the EBITDA and on the margins. And that's been the...
Just to complete that point, Rishabh, so whatever unit you track for railways, what is the improvement in sort of profitability at a unit level for you, now compared to earlier years? say 5 years ago? That is one. And second, can you guide the market to for FY25? You did 161 crores in profits. What could that number look like in 25?
So in 25, we are looking to increase revenue. So we expect EBITDA percentages to remain consistent. So the 25% baseline EBITDA that we achieved for FY24 was the consequence of this transformation that I talked about. Now we intend to grow and maybe a top line of around 20-30% in FY25 and maintaining the margins. So we expect this kind of growth to continue. And in terms of the railway metrics, the way we track the railway performance is more on a per square meter basis. So it's improved by about 25-30% vis-a-vis what it is in previous years. But it's not only a consequence of margin. The volumes have also gone up. So there is this big push in infrastructure investment in the country. So the railways, again, is a consequence of that. So, it's been margin and volume. So it's a combination of two. So I would be, misstep if I spoke only in terms of margin. It's both effects.
All right, Rishabh, very quickly then, before we let you go, at peak levels, what kind of revenues can you do? You did around 1,100 crores. With the current investments, what can you do at peak levels?
We can get up to about 2,500 crores with the current investment.
Okay. All right. And do you think by FY27, you get to around that 2,400, 2,500 crores with margins in mid-20s? I ask you this because there's only one brokerage that's really covering all, that's Ventura, and they believe so. You think going by the run rate, FY27, you'll be looking at 2,400, 2,500 crores, margins at 23%?
Absolutely. We have a really large opportunity in front of us. We've got a good order book, and we are in the right. So it's very achievable.
All right. Working capital days are still relatively high, though, at around 180 days. Do you expect that to come down a little bit? And since you're debt-free, will you look at tapping the markets, raising some equity, working capital, as well as raising any money? Go ahead.
So right now, we are pretty well capitalized. The working capital is used really to drive a lot of the US business, because when we go down to the consumer level in the US, the cycle is pretty long, But in terms of the raising money and debt and things like that, as the business continues to grow and as we continue to get more business coming through the system, we will look into that in a future date. But as on date today, we are pretty.
Could you just leave us with one number, which is the current order book, and what is the order visibility that you have over the next 12 to 18 months?
Yeah, so we have the visibility for up to 2 quarters worth of business. So we have visibility of about around 500 crores already in terms of the order book. And, we keep replenishing this order book quarter on quarter. Now, we are pretty optimistic through the summer months right now, and through the next 6 months. It's a pretty nice period for the business. So, we, remain in a pretty good place.
Okay, all the best. Thanks a lot for joining in. The street is definitely very excited with the way the business is growing and has rewarded the stock quite handsomely, and shareholders as well. Thanks a lot for joining in. That's a stock that has doubled in the last 1 year. Devin Choksi is still with us, so let's get his view in. Devin, vinyl flooring, right? I mean, it's picking up quite a bit, especially for Indian Railways, for EV buses, and the street is confident of that. But at this price, do you think a lot of the good news is in, or do you think there's more to go?
So from the perspective of looking at the growth, I think there is still a long way to go. I think because I guess that the first time India is experiencing the alternate space floorings, I think, in a big way in different applications. So to a greater extent, I think we believe that I think this is one space. Plus innovation is happening big time in this particular space with the new product quality coming up. So from that perspective, I believe that I think the growth prospects are very bright. At the same time, I think one area where probably I think the higher amount of prospects also lies is in the area of exports. And particularly, I think with the BIS in, I believe that I think the export is going to be, I think, more rewarding proposition even for the domestic players, I think, who are basically going to take the advantage out of it. So we believe that I think there is a good growth prospects going ahead. Maybe some amount of play would be on the margin side, but I believe that I think as long as the petrochemical prices are remaining steady, probably I think the margins are not going to be affecting these companies in an adverse way. And as I heard the management also saying, this is the same kind of hearing the same kind of, I think, sentiment being echoed by most of the other management was supplying to railways. The government is now spending money for quality, and they are basically giving margins to the players as against earlier period. So that is once again, I think, giving some amount of clarity of higher growth and higher margin continuing in the business. So we remain positive on this space per se.
All right. If you take a 25% growth on what they did and maintain sort of net margins at similar levels, they do about 200 crores in FY25, 8,000 crore market cap. So this year, I mean, they basically are trading at about 40 times earnings. The issue is just not the growth or the visibility, etc. Valuations. I mean, nothing comes, of course, cheap. We'll take a break here. We'll talk about technicals. Kush Bora and Sudarshan Sukhani will be with us with their trading ideas for today and beyond. Stay with us. Okay, welcome back. The pre-open session is 7 minutes away, and we'll get to that in just a bit. 100 points lower on the GIFT Nifty. That's the opening indication. Kush Bora and Sudarshan Sukhani are with us with what they make of things. Gentlemen, good morning. Good to have both of you here. Sudarshan, let's start with you. What's the setup like? Near term, how would you trade it, and in what way?
Yeah, good morning. As you said, the chances are the Nifty may open a good 100 points lower. I think that would be a buying opportunity. This market is simply getting a little nervous ahead of the exit polls and the real results and whatever else. So this is just minor nervousness. Maybe large traders have already built their positions and they are not interested in adding anymore. I can't answer why this is so, but this nervousness has been found to be there even in earlier election results. Just prior to the election results, irrespective of the opinion polls, the market gets nervous. This is a buying opportunity. I'm repeating that. So I can't give you a number because it's difficult to say where the markets will land up, but somewhere around 22,700, look to start building long positions.
Okay, that's some sane advice, saying that the market generally gets nervous ahead of election results. So don't be too perturbed by that and continue to stay long. Got it. Kush Bora is also with us. Kush, would you agree that this is a buy on dips market? And is that the best way to look at it? That, if we do get some nervousness, then one should still maintain their long positions?
Hi, Sonia. Very good morning. Well, I agree almost entirely to that, because see, what's happening is before the big event, the markets are, or the traders rather, are going light on positions, and that is absolutely understandable. So what's happening is that this is a healthy sign. You wouldn't want to take a very heavy position, moving into the big result. What this does is that it also leaves a bigger room for an up move on the day of the result. So from my perspective, this is entirely a very healthy move. Now, while in all honesty, we do believe that the markets could make a near-term top following the election result, or maybe a couple of days after. Very difficult to time, but perhaps some a scenario like that. But up until the election result, running into it, the only position that you can take right now is long. And till the time 22,700 is held, I think this is still a buy on dips market. The confidence also comes from the fact that the bank Nifty is also starting to participate. Yesterday was just a mere profit booking. So even here till 48,800 is held. Bank Nifty is a long trade.
Okay, all right. Got that view on the indices then. Kush, you go ahead and tell us what are the stocks you're tracking?
Well, I think the infra theme will continue and has been rewarding for a while. So PFC is on the radar. From a near-term perspective, we're looking at a 530 and a 555 kind of a target. 500 is a good support zone, so should act as a stop loss. Torrent Power, this stock is really wanting to move higher for the past 5 sessions. It's been knocking on the doors of that 1460 level. So the more you attempt, the more likely you are to break that level. So 1465 is the target, the first target, 1495 being the second target, and the stop loss comes in at 1400.
So Darshan, what about you? What would your ideas be, both on the buy and the sell side?
Yeah, well, as I explained, the focus should be on the Nifty today. But for individual stocks, I have 2 intraday shorts to start with. One is Lupin, which is in some kind of a minor downtrend. Sell short intraday with stop above 1715. And BHEL, which has seen a handsome rally and could consolidate. It's an intraday short with a stop above 319. There are 2 buying opportunities. The first is HDFC Life. It's also a positional trade. Consider buying it with a stop under 546 and IGL buy with a stop under 437.
Okay, thanks for that, gentlemen. We'll do one thing. We'll take a quick break. When we come back, we'll have the pre-opening rates. Also, Pradeep Kheruka, the chairman at Borosil Renewables, will be joining in to discuss their Q4 performance. Stay tuned. Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. Let's get straight to some F&O action now. We have Chandan Taparia joining in. He's a derivative and technical analyst at Motilal Oswal Financial Services. Chandan, hi, good morning. This has been a volatile market, but how does one approach it today? And what are the stocks that you're looking at?
Good morning, Sonia. Thanks for having me. So we have seen some volatile swings in the last two trading sessions. Nifty 2 days back made high at 2310. But on last trading session, it formed a bearish candle corrected by around 100 points from its higher levels. So major trend is intact, but some sort of volatile swings cannot be ruled out for next couple of days. India VIX is at 24 levels. In the entire month, we have seen a jump of more than 100%. VIX rallied from 1011 to 24. So rising volatility is the reason of some sort of volatile swings in the market. And as per the standard deviation model, we believe that 350 points range could be now new normal for next couple of days. So one need to fasten the seat belt to deal the volatility. If I look at the entire rollover setup, we are in the expiring week. Tomorrow is the monthly expiry for Nifty. And month-on-month basis or expiry on expiry basis, Nifty is just up by around 1%. So only the decline and the recovery was happened during the month. And volume weighted average for the week or month is at 22,500. So we are slightly higher than the volume weighted average. So because of that, buy on decline could be there. Broader range for the index, based on all the data fact, is likely to be in between 22,500 to 23,100 levels. Now looking at the Bank Nifty index, we have Bank Nifty monthly expiry today, and month-on-month basis is up by around 1.3%. Volume weighted average for the month is 48,500, and we are slightly higher than the volume weighted average. So 48,800 and 48,500 could act as immediate support, and because of that, it may see positive to range-bound bias. So in both the indices, we are expecting some sort of volatile move in a broader range, but major bias could remain positive as major trend of the index is bullish as of now. Now looking at the stock wise, first is buy on Exide Industry. This stock has given a breakout from its pole and flag pattern on the weekly chart, which has bullish implication. Overall, we have seen built up of long position and longs are rolling from the current month to the next month. It has given a consolidation breakout of last 28 trading session, and because of that, we are expecting a fresh rally, which can take it to us 535. One can buy Exide Industry with a stop loss of 495. Second trading idea, that is buy on Divis Lab. We have positive on the selective pharma name, including Glenmark, Divis, and Divis has been making high top, high bottom on the daily and the weekly scale, comparatively holding well. So we believe that this stock can see some outperformance. One can buy with support of 4,300, and we are expecting a move towards 45.50 in the Divis Lab. Last trading idea, that is sell on Ramco Cement. We believe that this stock can correct by 5 to 7% from current level. Major trend is negative. It has been making lower top, lower bottom, finding hurdle at key moving averages. So clearly the negative structure is visible on the data and the chart study. So one can sell Ramco Cement with a stop loss of 780, and stock can drip down towards 730, 720 zone.
Chandan, pretty comprehensive, and those three trading ideas as well. We'll come back to you. Thank you very much for joining us with some of that trading strategy from an F&O perspective. Pre-open is on your screen now. The Nifty is down 100 points. The sensex is, just finding its feet, but it is down. It is red. So it's like continuation of where we left off in trade yesterday. One more interesting company is, of course, Borosil Renewables. Subdued set of numbers for the fourth quarter, and actually FY24 has been pretty tough, right? We'll put the numbers up on the screen for you, but let's welcome in the management. We have Mr. Pradeep Kheruka, chairman of the company, with us. Mr. Kheruka, good morning. It's always great to speak with you. Prashant this side. You mentioned in your presentation as well that the dumping from China after the removal of the duty in August of 22 essentially is completely sort of turn things in a negative way for your business. And it's not just your business, but others in the sector as well. And as a result, of course, FY24 has been a pretty tough one. How has 25 started? And what can we expect, sir? On a standalone basis, for example, margins have fallen to about 12% compared to some 26% the year before. What are expectations for 25?
Well, there's a saying in English that says one man's meat is another man's poison. So the problems with shipping in the Red Sea have caused an increase in freight rates. And freight rates from China to India have risen from some $700 a container to now $3,500 a container, causing the landed price to rise. And what sometimes the basic customs duty cannot achieve, or non-implementation does not achieve, is achieved by a change in the logistical cost. So I would say that the year has started with a situation where the price of imported solar glass is higher than what it was, say, during most of last year. And that means that we get a better price realization. So it started off well. I would say that in Europe as well, which is where we have some 350 tons per day, the government is finally getting into its act together, and they are yesterday passed some law that says that they're going to action the provision of solar power from domestically produced modules and domestically produced components. So with that coming up, we would be in pole position to supply that demand. We've had a rough time in Europe as well. And fortunately, the good thing both in Europe and in India is that we have a first-class manufacturing setup. We have a first-class team. So if the demand is there, we are ready and waiting for it.
Could you put numbers to it, Mr. Kheruka? What would this mean? India's looking better. That's interesting, the tariff bit that you spoke about. So that's causing the landed price of imported solar glass to be much higher. So, which means you're in a better competitive position. Europe is looking. So what's the number? Give us some numbers, sir, for 25.
That's one thing I never do. I never give any kind of number which is predictive. All I can say is that there are two things. One is that I've been meeting people in government across different ministries and so on. I have been given assurances that the basic customs duty on glass, which is about 15%, which is not small, was set to be, there's an exemption circular, which is exempting imports from duty. And that exemption was going to end on the 31st of March. But that circular has hundreds of items in it. And they decided to postpone the whole thing till the 30th of September. And they wanted the new government to decide what to postpone, what exemptions to remove, and what exemptions to retain. So I've been told that the exemption on imports of basic customs duty, so far as solar glass is concerned, is definitely going to be removed. We have to keep in mind that in the year 2022, we were the only company actually manufacturing and supplying solar glass in India. Today, there are 5. So with from about 180 tons a day in India in 2019, we're up to 2,300 tons a day with 5 companies. So the 5-year anti-dumping duty that had been imposed in 2017 caused an increase in production by nearly 13, 14 times. That is the power of the tariff for you. And the strange thing is that imported cells are 25% duty, imported modules are 40% duty. For some reason, glass got left out. But anyway, that's going to be corrected. So we are looking with confidence to the future.
All right. Hi, Mr. Kheruka. So you're sounding optimistic about the future, which is always a good thing. And you're saying the policy measures as well could support you. So your shareholders will take heart from that fact. You had commissioned your SG3. So as of now, the India utilization levels are at optimum levels?
We had commissioned a furnace, which was 500 tons a day. So we are drawing 500 tons a day from that already. But being Indian, we are not happy unless we're drawing 550 tons or 575 tons from that furnace. So all of that is in progress. So I would say we hit rated capacity fairly early. And we're going, we're producing and selling everything that we make. On the 31st of March, we had, you could play football in our warehouse.
All right. I like the way you put that, Mr. Kheruka. The reason I asked you is because what about SG4 then? You had plans earlier. It was postponed, I think, a little bit. So two-part question. One is you have taken an approval to raise some money, which could possibly be by the rights issue route. So tell us, what will you use this money for? Will it be used for additional capex, or will you be looking at paring down some debt? Give us some clarity.
We're likely to pare down debt. We have a total of about 500 and something crores. We'd like to see debt at about 200. So, that would be very comfortable for us. And that would give us, frankly, we are all ready for another 1,000 tons or another 1,200 tons. Our batch house is good for 2,000 tons. We're only drawing 1,000 from it. Our electrical installation is 45 megawatts, which is good for another 1,200 tons. So these are two important items of capex, which we have already been able to sort of spend, and it's there in reserve. So the next furnace was not going to have as high a capex as a new furnace that somebody else would set up.
Got it. So you're looking to, sure. So sorry, Mr. Kheruka, this is Sonia. We have just a couple of minutes left before the market opens. I wanted to squeeze in some more questions. What is the market share currently? I think you were at 20% in 2023, but where are we at right now?
The market demand has been rising. The production of solar modules has been rising. It's very, very volatile. The only thing I can say is that about half the production of other manufacturers is lying unsold, or half the capacity only is being utilized. We are able to sell everything. But, we are,
I just wanted that one number in terms of market share, sir.
I would say about maybe 750 tons. I haven't done the homework. The market share for Indian glass is about 35%. So we're still 35%. Importing 65, for all Indian glass. So we're selling everything, and then the balance is coming from the other manufacturers. But with the new schemes, the ALMM that has come in from the 1st of April has given a very great fillip to domestic manufacturing. And the other thing is the Pradhan Mantri Yojana for the rooftop. So 1 crore households are going to get solar modules, all made in India. So the demand in India for glass is going to really rise exponentially. And the question is at what price are you going to sell? And hopefully the price would see better numbers, going forward, more or less immediately, because the land price has gone up immediately.
Got it, Mr. Kheruka. Everyone is waiting for the election result. You are too, but there's of course that tariff bit which you said, officials indicating that it's a new government, which perhaps will take a call and may come through. You remain confident that something
the indication, sir, is that so far as solar glass is concerned, the exemption is going to go. That's what the indication is. So they'll take a call on the hundreds of other items, but for glass, I think they've taken a call. But we have to see.
Wait. All right. Great conversation, and thank you very much for your time as always here on CNBC-TV18. Well, that's Borosil Renewables, stocks at about 480. But it's election time, election results times. Everyone has got a view. CLSA this morning has come out with a note, and they are talking about what's the best kind of way to get exposure to what the market is betting on, which is continuity. Hormuz has got that up for you. Hormuz, morning.
Morning, Prashant. And CLSA has identified 54 stocks which it classifies as quote-unquote Modi stocks, which are projected to be direct beneficiaries of the government's policies. And they are expecting that this outperformance that 90% of these Modi stocks have had over the last 6 months will continue if the current government is re-elected back to power. Now, some of the Modi stocks that they have identified include L&T. Most of them are PSUs, NTPC, NHPC, PFC, ONGC, and the telecom stocks as well, Bharti Airtel, Indus Towers, and of course Reliance Industries. And the bets beyond the Modi stocks, they include the likes of HDFC Bank, Axis, ICICI, Bajaj Finance, and of course Zomato and Avenue Supermarts as well. Now what they say is, however, on the flip side, they are saying that this narrow theme-based rally which the market has seen over the last 6 months in anticipation of this election results may end sometime in June or July, and as a result of which banks are the best risk-reward play in the second half of FY24. And what they also say is that most of these positives may have already been baked into some of these names, which may result in profit booking in some of the less patient investors of these Modi stocks. And they allude to the last two results, election results, where PSU stopped out a few weeks after. So a mixed bag coming in from CLSA, but 54 stocks identified. Back to you.
Okay, thanks a lot for that. Before the market opens, let's put the focus on Paytm, as sources say that Vijay Shekhar Sharma has reached out to potential investors to buy a stake in OCL. Ritu is here with more details on that. Ritu.
Well, Sonia, first, Vijay Shekhar Sharma is in exploratory talks with several potential investors, sounding them out to buy a stake in 197 Communications, which is the parent company of Paytm. And Adani Group, we understand, is one of the potential suitors that Vijay Shekhar Sharma has directly engaged with. There is no clarity yet on what the status of the discussion is or any possible closure of the deal just yet. If you recall what the shareholding in Paytm is, in 197, that is Vijay Shekhar Sharma, the promoter. He directly holds about 9.1% stake, another 10.28% through Resilient Asset Management. So that's a 19% plus stake. And SAF Partners, another 15.4%, with Chinese and Fin close to 10%. So, which of the investors may be selling, that is unclear. And there's no direct talks of any stake sale in the bank yet. That is also something that we picked up.
All right, fair enough, Ritu. Thanks very much for that. Market opening up on your screen. The indices are going to come up. The mid-cap index is down about 0.4. Sensex is down 0.3. Nifty is down about 75 points. So it's a lower start. And the bank Nifty is down about 1/3%. So uniform, near 0.5% cut coming through across at least the frontline large cap indices. Advanced decline on the BSE is also up on your screen, and about 100 stocks separate. Losers from gainers, more down than up. But this is just the start this morning. But all about stocks, Sonia has got that. Sonia.
Well, thanks a lot for that. As you rightly pointed out, right, the main focus area really is the Nifty, which is under a bit of pressure right now. So down almost about 90 odd points. We'll keep our focus there squarely. But apart from that, Hindalco is the one I'm looking at this morning. It's looking to raise $1 billion from the Novelis listing on the New York Stock Exchange. So Hindalco is up almost 0.5% as we speak. It has seen a big rally in the last 1.5 months. So just keep that on your radar. PNB Housing, there are some block deals likely today of 2.7% equity. So PNB Housing is the one that's taking a deep cut this morning, down almost about 8 odd percent. Keep watching that one. IRCTC, mixed bag this time around. Although the revenues are higher, it is the margins which are down 220 basis points. And this operational weakness is not taken well by the street. The stock is down almost 3.5%. To be fair, IRCTC has had a pretty decent run. By the way, that block deal has taken place on PNB Housing Finance, where 2.7% equity has changed hands. So do, get that stock back up on your radar. Apart from that, you have Aster DM, where it's actually looking good for Aster DM this time. The margins have come in at 16.5% versus 15% earlier. EBITDA is up almost about 29%. But the stock is coming in for some profit taking this morning. MedPlus Health is the other one I'm looking at. The margins have improved. The revenue has risen almost 20%. The stock is bucking the trend, market trend, and outperforming the market. So just keep that on your radar as well. And Prestige Estates is the other one. The EBITDA growth has been pretty solid. In any case, real estate stocks have been doing well. Margins have picked up to 38% versus 26%. Just a couple of more stocks. Paytm, let's see how that one is reacting to the news flow. So coming up on your screen in a bit, Paytm, that one is up almost about 5 odd percent on the back of the news flow that you just heard from Ritu. So keep an eye out on Paytm. And Responsive Industries, a company that we just spoke to a while back, very bullish commentary, strong numbers coming in from Responsive Industries. It manufactures, vinyl flooring for electric vehicle buses, for railways, etc. So the street likes what they heard from the management. The stock is up 3 odd percent. But otherwise, for the market, Yes, it's down but not out. As Sudarshan Sukhani was telling us a while back, generally ahead of election results or the exit polls, the market tends to get a bit volatile and a bit jittery. That's pretty much what you're seeing on the screen right now, but it's all about individual stocks. Back to you.
All right, Sonia, thanks a lot for that. Well, a few stocks in the broader markets are getting pummeled, actually. Engineers India, the EBITDA number came in down by close to around 50%. The margins came in at sub 10%. That compares with around 19%. So that one's getting a hard smack today. You have GNFC. Well, the EBITDA number was down by 60%. Margins came in at around 7 versus 16%. So that's the other big loser today. Vocart is the other stock. Let's see what's the reaction out there. They reported an EBITDA loss in comparison to an EBITDA profit. The revenues are up by close to 3%. For the time being, that stock's holding more or less steady. Another big gainer in the last few years has been Linde. The stock is up 5-6 times, I think, in the last few years. Well, the EBITDA number was down by close to around 4%. That one normally gets bought on dips for the time being as well. That's U-turn from the day's low. It's well in the green. MTAR Tech, well, you had the EBITDA number that was down by close to around 60% approximately. So that stock comes up for you in the screen. You had the margins that came in at around 13%. That compares with around 25%. The street doesn't like it one bit. The stock is down in today's session. Capacite Infra, well, you had a reasonably good set of numbers. The stock, remember, had run up in the last few days, but that one's holding well in the green, I think. So it's up close to around 2% in otherwise wobbly market. And CMAC is another stock that's holding well in the green on the back of good numbers that we saw coming in there. A bit of a turnaround quarter for that company as well. Add to the list NBCC. That stock, in fact, is holding in the green with a gain of around 2%. Margins coming in at around 6%, compares with 3.5%. The street loves that. Up 3% as we speak.
All right. Sorry, beg your pardon. Paytm is up 5% and it's got volumes on it. So 360 on Paytm. Started tentative and then it's, of course, moved up from that point on. Ritu was just telling us about that story. We'll revisit that a little later. You got 3M India, which is up 4%, 4.5%. It's the number 2 largest volume traded name, 3M India. Hardly ever figures on the list with these kind of volumes, but it is this morning. Brigade is up 5.5%, so it's a big one, 1260. Again, huge volumes on Brigade. I think we did mention Campus after number 6% on Campus, so looking good. Capacite Infra, that's up 1.6%, started to sort of perform once again over the last couple of days. Gensol Engineering is up 2.6%, back above the 4 digits now, 1,035 on Gensol. Torrent Power is up about 2%. And I think you've got GE Shipping, which starts about 3% or so in the green. Sumitomo Chemicals, big day, sort of decent move yesterday. It came off the day's highest point. Actually, in the last few sessions, from $400 stocks moved up to about $450 in, I think, about, 10 odd trading sessions or so. So it's been a pretty good ride for Sumitomo fairly recently. PNB Housing, of course, is the top volume-led cut. It's down 7.5%. So 729 on PNB Housing. And Cochin Shipyard is down 3. IRCTC we mentioned. Inox Wind after yesterday's large cut is down another 7%. Stocks at about 137. Inox Wind has got very, very large volumes once again. IRDA, EIL, Nigel mentioned. Loda, that is Macrotech, is down about 3.5%. Aster DM numbers, Ekta mentioned that, 3% down. Nazara is down about 3% as well. Nazara, again, last 2 days has had a decent run-up. So just about under a 100-point cut is what you have, 22,791. So we'll sort of get back with more names and market trends, etc. But for now, let's welcome in Mihir Vora, Chief Investment Officer at Trust Mutual Fund. And he's joining us in our studios. Always good to see that. Mihir, great to have you with us here. Good morning. Thanks very much for your time. CLSA this morning is talking about 54 Modi stocks, 54 companies which are perceived as direct beneficiaries of PM Modi's policies, half of which are PSUs. I'm sure you've seen that report. Lots of those names, L&T, NTPC, NHPC, PFC, ONGC, etc., etc. What do you make of something like this? It's, of course, a lot of interest about what can do well if the market's base case does come true on Tuesday. Your thoughts, Samir?
Certainly. The markets are hoping and looking forward to continuation of the existing policies, and the biggest thrust of the government has been to try to create as much as physical assets as possible, especially in the manufacturing space, but that needs to be supported by infrastructure and real estate, etc. So I think a lot of the PSUs in the space, utilities, the defense manufacturing, the railway-oriented stocks, some of the lenders to the infra, all of these fall into that broad, physical asset creation theme. So to that extent, I would not be surprised that if there is a, continuity of the regime and the expectation and the market's, outlook, which is more of the same, and maybe acceleration of the investments theme, then these are the kind of names which would, do well. I would not restrict it to only PSUs. Of course, some of the PSUs are relatively cheaper, so there may be scope for some more re-rating. But in general, I think the fact that the policies should continue and all the thrust on manufacturing and infrastructure should continue is something that will be welcomed by the market once this question mark or uncertainty is past us.
Okay, well, for now, the market is down about 0.5%, but there are several stocks which are bucking the trend. So don't lose sight of that, especially the real estate names. Just look at that. Brigade Enterprises is now up almost 8%. Of course, there's been, a lot of positive news flow on the real estate space as well. Then something in the capital goods space, Thermax is up almost about 3%. Torrent Power is up, Godavari Power. A lot of these companies, right, looking pretty good this morning. So, yes, there are stocks that the street still likes despite all the volatility. Mir, thanks for joining in on the show. I wanted your thoughts on once the election, verdict is out of the way and the market moves on, right? In all likelihood, of course, it will move on the upside. If yes, where do your preferences lie now? What are the pockets you think have still value and growth?
Basically, as we've discussed this so many times, that the local economy should continue to grow much better than the rest of the world. While probably the US is doing much better than expected, we still will be the fastest growing economy in the world, the large economy in the world. So I think local oriented stocks, and which includes financials, because ultimately if the GDP is to grow faster, financials have to do well. And to that extent, I think financials, having underperformed for almost a year now, should offer some good pocket of value. So that's one big area that I can think of. And even some of the construction companies, engineering companies, the cap good companies have become a bit expensive, but some of the construction linked EPC companies still offer good value. And of course, when you talk about the domestic theme, you also talk about discretionary, which is just about picking up. So the auto space, the discretionary space are spaces where we can see some more re-rating happening.
All right, Mir, what about the premiumization theme? Indians want to consume differently. Some people say that there's a slowdown. Some say, well, the way they're consuming has changed. Everyone wants a better car. Everyone wants to drink better alcohol. Maybe if you were to talk about that, wear better clothes, better shoes. So how do you play that theme?
Absolutely. So that's the second theme that we are very bullish on, apart from physical asset creation, which is exactly what you said, premiumization. And that would include, savings being funneled into the capital markets. So then we are also talking about pockets like exchanges, like brokerages, like, wealth management outfits, insurance companies.
Just to talk about that, the equity play, these brokerages, CDSL and the likes as well. How much of the good news is in the price out there? Some of these, BSE, case in point, 600-700 rupees just a short while back. It's at 2,500 rupees plus.
Absolutely. So, one can obviously debate the valuations, but the question then in that case is, what is the long-term trajectory?
Right.
Are we looking at a 5-year, 10-year kind of a growth path for these segments? Because if that's the case, then one can really take a longer-term view and, play in these themes.
Okay. So some of these themes, as Nigel was talking about, people want better cars, bigger houses, perhaps more expensive houses. Particularly in real estate, right? If you can't afford an expensive house, does it make sense?
1 minute. They want expensive houses. They want bigger houses,
yeah.
But cheaper. Who wants expensive houses?
That's an ideal scenario where you get a bigger house which is cheaper, but that doesn't work in Bombay. But yeah, you want to tell us, if I can't afford a house in Bombay, at least I can buy the shares, right?
Certainly.
So do you think that it still makes sense to buy real estate stocks?
Certainly, because, we are coming off the back of almost 8 years of, stagnation in residential part. Commercial has been relatively better, but the residential, did, stagnate for almost 7-8 years, beginning 2013-14. So to that extent, we've just seen maybe a couple of years of uptick. And while I'm not betting on price hikes anymore in terms of, as you said, the cheaper houses or expensive houses, but certainly volumes should pick up. And obviously, we should not bet on the 20 crore, 40 crore kind of ticket sizes, but the 1 to 5 crore range is certainly that some place that we can look at.
You guys were talking about the capital market plays, etc. We just spoke with Ramdev Agarwal recently, and he was also others have also made the point that this explosion of F&O on the F&O side that we've seen as compared to cash market turnover, I mean, the difference, that ratio is some of the highest in the world, right?
Yes.
And the proportion is just very, very large as compared to the underlying market. And can this continue, or will, once the new government comes in over a period of time, I mean, they'll give this a look, make it a little more sort of, tougher to kind of participate on that side. We don't know, I mean, how, but is that something which you think is a risk for intermediaries, financial intermediaries, especially, I think, exchanges, brokers, more than anything else?
Certainly. My guess is that they should not really tweak around with capital gains taxes.
Not capital gains, not capital gains, to be clear.
Maybe
I mean,
make it a little more, expensive to trade. So you could see some kind of fees being levied, etc. Because even the finance minister has expressed, and we have seen many voices.
Yeah, she was in Bombay, she spoke
exactly,
about that, yes.
Yeah. So to that extent, there might be some steps where, at least it becomes a little more friction. There's a little more friction while trading. Right now, it's just too cheap,
Anything else, Mayor, you want to sort of leave us with any other sort of, bets or, that you're taking at this point?
No, I think we are just about, at the cusp of consumption being revived. So while the government capex spending has done very well over the last 3 years, and it saw us through the COVID downturn, we are basically now betting that the other two levers, which is private sector investments and consumption, should pick up. So while the rural consumption has not really picked up, that's one bet one needs to take, because then we'll have a holistic, recovery instead of a lopsided recovery, which is more towards only premium consumption.
And so QSR kind of names, I mean, from a listed perspective, or is it
QSR,
staples?
I would still consider a little more high end. I'm talking about the lower end of the real consumption, which has not really picked up. If that picks up, then we'll have a really good overall recovery.
And that will happen, you think there'll be some sort of, I don't know, hoping for too much, maybe personal tax cuts or something? I mean, to boost put more money in the hands of consumer?
So the kind of consumption that we are talking about are really low end. So probably you can see some more targeted
transfers.
Transfers, exactly.
Okay. Any of these, spaces which have seen a huge pickup lately, whether it's defense, Indian Railways, electric vehicles. We were just speaking to the management of responsive industries. They make, vinyl floorings for railways, and they're saying that potential is huge. Demand is picking up in a big way. So any of these spaces that you think deserve merit even now, despite the run-up?
Certainly, because these are all trends and themes which are going to last for 5-10 years.
Okay.
And these have the full backing of the government.
But they've rallied a lot also.
See, the markets always look forward, and what matters is what is the TAM, the total addressable market. Okay. In some of these cases, we are really just starting from scratch, So to that extent, the growth path and the runway can be much longer in these cases.
Okay, all right. We'll leave it there. Actually, Mayor, stay with us. We want to just go to Ritu, if she's with us. And maybe, I think Ritu will be with us in just a bit. And we want to just talk about Paytm. By the way, do you have a view, Mayor, Paytm?
I mean, obviously, I can't comment on individual stocks.
Okay.
But all I can say is that when I was here last month, doing our NFO, there were three themes. We already talked about two. One is premium consumption. Second is physical asset creation. Third is disruptive business models using technology. So there is a bunch of stocks, 5-7 stocks, large stocks, which got listed in the last 2 years.
Right.
But I can see almost 20-30 more stocks which will get listed in the next 2 to 3 years.
Okay.
So that is one space where companies using technology to create new business model or disrupt existing models. That's going to be an exciting space for sure.
All right, Mihir, appreciate you joining in and giving us a view on all those sectors as well as themes. And by the way, congratulations. I believe it was your work anniversary, and this month itself 30 years. So all the best.
Yes. Wow. Thank you so much.
And new challenges you've taken up. So we wish you well on that front as well, Mihir. Well, time to move to our next management then, I think. Or do we have Ritu with us to update us on the latest in terms of what's going on with Paytm. Ritu, please fill us in.
Well, to begin with, Vijay Shekhar Sharma has reached out to several potential investors to explore a stake sale in 197 Communications, which is the parent entity of Paytm. And one of those potential investors is the Adani Group. Now, we've been given to understand from our sources that discussions have been ongoing with Adani Group, although there is no clarity on any potential closure of this deal just yet. That said, this is a stake sale in 197 Communications, the parent entity, and not the payment bank, as was also being speculated. If you keep in mind, Vijay Shekhar Sharma holds about 19% plus stake in 197 Communications, a little over 9% directly, and the rest through Resilient Asset Management. And then there have been, Chinese investors like Anfin Netherlands who hold close to 10% and have been bringing down their stake over a period of time. So it is unclear which of the investors, may sell stake if the deal does materialize. But as we understand, it is nowhere close to being done just yet. The other part is, as far as Paytm Payment Bank is concerned, there is no direct talks of any stake sale just yet. There's also been questions about what happens to the fate of the payment bank, and there we've been given to understand that some of the customer deposits are yet to move out from the accounts and the wallets, and once that process is fully completed, only then, will there be any next regulatory movement on the bank. Now, we've reached out to Paytm as well as Adani Group for a comment, about this potential stake sale, and we're still awaiting those. But meanwhile, Paytm, of course, has clarified to exchanges, saying, that it is not engaged in any discussions with respect to Vijay Shekhar Sharma's stake in 197 Communications.
Okay, all right, Ritu, thanks a lot for joining us and giving us that update on Paytm. We'll keep coming back to you as and well you get fresh updates on that front. But as promised, let's get straight to the management of RR Kabel. They reported actually a good quarter. Quarter 3 was a little bit subdued, but they've returned back to their growing ways in quarter 4 itself. To understand what's the outlook from here on, we're joined by Mr. Rajesh Jain, the CFO of the company. Hi, Mr. Jain, good morning, and thanks a lot for joining in. Well, in the past year, you've grown by close to around 18%, and you've outgrown most of your peers, barring Polycab. For this year, what kind of a growth are you penciling in? And could you tell us, in terms of a market share, I think it's around 7% as of now. How do you see that panning out as well going ahead? So growth, how much comes in from FMEG, and what about the market share?
Good morning. Thanks for inviting us for this call. If you see, we have always outperformed majority of the time to the industry, and like this year also, in volume terms, our wire and cable business has grown around 20%. And even FMEG right now, that has about 12% share in our revenue. And going forward, also, we expect to grow in wire and cable around 20% volume growth. About revenue, we cannot speak because it depends on the metal prices. But in volume, we are targeting and expecting to grow at 20%.
Okay. All right. You briefly mentioned about the FMEG business as well. So could you tell us what is the revenue number we should look at in the FMEG business? And you had briefly mentioned that when you hit 1,000 crores of FMEG volume revenues, then you break even. Is that in the coming year?
So, yeah, we are expecting revenue growth and we will expect to grow and achieve the revenue growth of 1,000 crore in this FY 25. And about EBITDA, still we are not sure. We are expecting to achieve break even in next 4 or 5 quarters. And we'll try our best to achieve that.
Okay, Mr. Jain, good morning and thanks for joining in. So you said 20% volume growth is your target for the next year. Can you tell me in terms of demand, right, for cables and wires particularly, what are you seeing now? Where is the demand coming in from? Is it from housing wires, industrial wires, power cables? Where is the maximum demand from?
So overall, Indian economy is doing good, and we are having good demand from domestic as well as export also. Export already contributing almost 30% in our revenue. So we have good demand from residential sector also, wire also, institutional or infrastructure sale. So this will be a mix of domestic as well as export demand.
Mix of domestic and export demand. Okay. Can you tell me particularly for export, what is the kind of demand that you're seeing? What's the export contribution currently? And in the next 2 to 3 years, how much can that grow to?
So export was always focused since the beginning of our company, and still right now it is contributing almost 30% in wire and cable business, and going forward also it may go up to 35%, but it will remain in this range only, from 25 to 35% export will be there. In export, we are getting very good demand for our cable also from Europe and other developed market, and it is doing very good.
So this 25 to 35% rise in exports, right? By when do you think you can hit that 35% revenue contribution? And would that mean higher margins for you?
Of course, see, whenever there will be higher volume growth, it will convert into margin. Since it is like 35%, we may achieve in the next 2-3 years.
All right, got that. Mr. Jain, good morning. Just a quick word on sort of underlying metal prices, right? Copper prices, which have been rising, and forecasts are that they'll continue to rise. I mean, how does that impact you? In what way?
So we have seen very much volatility in copper prices. It has gone up also, and recently in last 10 days it has come down also, and it is part of our business. So copper price will always be there, and till we can pass on the prices to our consumer, it is part of our business. So, but looking to the global demand, it seems the copper price will remain in the higher end only in near future.
Does it hurt demand? I mean, postpone demand in any way, or no? I mean, if it rises to what some of the forecasts we are hearing, it's been more up than down. That you would agree. Yeah.
Yeah, but I don't think it will postpone demand, because this is wire and cable is requirement. It is not luxury product. So anyway, you have to consume.
Okay, all right. Mr. Jain, I wanted some more color on this exports business, which is around 26 to 30%, as you mentioned. Earlier, I think you all were exporting wires. And then you all were looking at pushing through some cables as well. So out of the total exports, what is the mix right now between wires and cables?
So around 70% is wire and 30% is cable.
And you all are looking to change that mix?
See, we are expanding our capacities in cable more, and we have very good demand. So it is expected that we will grow by higher rate in cable in compared to wire. But there is growth in both the sectors.
Got it. Got it. Since your FMEG business is going to gradually move towards a break-even point once you hit that 1,000 crore mark, and you're hopeful in the next 4 to 5 quarters, on a blended basis, what should margins look at? Volumes will be there. FMEG moves towards break-even. So with these levers in place, how much better can margins be in FY25 in comparison to FY24?
So we are expecting to improve our margins by 100 to 120 bips on a blended basis.
100 to 125. So it will be around 8, close to 8 to 8.25%?
Yeah, that is the range we are targeting to achieve.
All right. Just one more question, sir. You have done close to around 6,600 crores. You're sounding very optimistic about business. With the current investments that you have made and the capex that you've already done, at peak levels, what can you do in revenues?
So, like capex plan, what we have planned in for FY24 and FY25, it is in line, and whatever volume growth we have planned for this year and next year, this will be we can achieve by the current capex. And now we will start working on the new capex also to meet the further demand of FY28-29 kind of business, because it requires almost 18 to 24 months to execute one capex cycle.
Okay, all right. We'll let you go on.
Just one point, Mr. Jain, on the office of the CEO. Is there? Will we hear the appointment of a new CEO soon? Is that, or will Mr. Kabra continue to hold that position?
So currently this is the situation, and since this is management call, so I cannot comment right now, because this will be decided very soon and will be informed to you.
Okay, and I'm not sure if we got a chance to speak with one after that announcement in April. Can you tell us what was the reason for the termination of the sort of CEO, the previous CEO?
No, this was management call, so I'm not part of that decision. So this.
Okay.
This was some internal reorganization.
Okay. All right. We'll leave it there. Thank you very much for joining us, and we sort of hope to hear more from you if there is any development on that particular front. We'll take a quick commercial break here. We're back. The management of RITES, Rahul Mittal is CMD at RITES. He is joining us on the other side for more on their business. Stay with us. Later, we'll also be joined by the management of MedPlus Health Services. They also reported fourth quarter earnings, so conversation coming up there as well.
Welcome back. This is Corporate Radar. Well, the market is not bad. Honestly, it's down about 75 points, but it's picked up a little bit from the lows. The mid-cap index is actually flat right now, so there is definitely some buying interest that's cropped up. Paytm is in upper circuit, up about 5%, and then you have others like, Brigade Enterprises up 4%. Real estate in general is doing well. Campus Activewear is up 12% right now. So lots of big moves coming in there. But RITES is the other one that we're talking about. It reported a muted set of Q4 numbers. Revenues and EBITDA came under pressure, while margins contracted on a year-on-year basis. To discuss this and more, we have Rahul Mithal, the Chairman and Managing Director of RITES, joining us now. Rahul, hi, good morning, and thank you for joining us. It's been a very muted Q4 as well as FY24 for you. Can you tell us what is the reason for this persistent decline that you've seen in the top line, and what is the way forward for the business?
Good morning. So let's dive into the numbers and see where the year started and where we have ended. You see, the year started with two huge challenges for us. One was an export order book of below 100 crores with no fresh export orders, export of rolling stock orders for more than 4 years, the COVID and post-COVID period, and a big shift in the quality assurance business, where 2/3 of that was from the Indian Railways, and which after about 4 decades plus was opened up to 4 players through a competitive mode. So we didn't want to get bogged down by this major challenges at the beginning of the year. We had a clear strategy to minimize the impact of these two streams of revenue. Both are high margin revenues. In fact, export is a high top line contributor to my stream of revenue. So three key aims which we had at the beginning of the year. First, to get an export order. And we've got 2 major export orders from Mozambique and Bangladesh after a gap of 4 years, as I said, totaling to about 1,200 crores in the last few months. 2, to diversify into more non-IR clients in the quality assurance business. And by the end of the year, from about 2/3 IR and 1/3 non-IR, the balance has shifted to 50% shift into non-IR, a large number of new clients. And third, to build up on our project consultancy business, which is our core strength. So that saw a 10% jump year on year. We had our highest ever project consultancy revenues. So all these 3 key focused strategies which we had at the beginning of the FY, as the year progressed, they started gaining ground. And we are confident that this has been the right direction that we are moving on.
So can you give us some numbers in the international consultancy segment, which was muted for reasons as you explained? What kind of growth can you hope to resume in FY25?
Yes, as you see, the year started with export order book of below 100 crores. Now we have 1,200 crores, 900 from Bangladesh, 300 from Mozambique. And these will start generating revenue by the third quarter. And so this year, we will build up on these 2 orders. And the way we are bidding aggressively across geographies in the export business, I'm sure that we would get some orders in the coming months also.
Got that. Mr. Mittal, good morning. Prashant here. Could you outline a fresh guidance for FY25 now? I mean, what should we expect? Top line, EBITDA?
You see, the year 23-24 was a year of consolidation, as I said, to hang on there and minimize the impact of these 2 huge challenges which are outlined. And now with these orders coming in, as also, are having maintained that trend of 1 order a day company, which we achieved in Q3. We managed to continue that in Q4. In Q4, we got 100 plus orders, totaling to 940 crores. So now we have a good enough steady base. And with now we will build up on our 22-23 benchmark, build up on that rather than 23-24. So we see a good, healthy growth on the EBITDA and bottom line, aiming for a appreciable growth on the 22-23 figures.
But what kind, if you can be specific, sir, what kind of growth? If you can put numbers to it.
Yes, what we would like to aim is that we, as we say, we are a consultancy company and we are a bottom line driven company. So we would aim for a healthy double-digit growth on our EBITDA and bottom line figures vis-a-vis the 22-23 benchmark rather than the 23-24 figures.
Okay, got that. Could you tell us what is the order pipeline now? Give us a sense on that, and how many orders are you L1 in? It'll give us a sense of the visibility.
So the year ended with an order book of 5,700 crores, and we haven't added the 900 crores the Bangladesh order, which came post 31st March. So the Q1, we've got already these orders at the rate at which we are progressing. Q4, we were one order plus one order a day. And the rate at which which Q1 is progressing is again in that trend. So I think we will be able to build up on this order book of 5,700 crores quarter and quarter.
Okay, so when you say build up on the order book, right, what's your aspiration? Where do you think you can end FY25 in terms of order wins?
You see, I would say that this trend of one order a day, which has been achieved in Q3, Q4, would continue. So one order a day it depends on the mix of the orders. Q4 was 100 plus orders totaling to 940 crores, which depends on the mix of the consultancy order as the export order. So I think we would maintain this one order a day with a healthy blend of both consultancy and export.
Okay. And is there any impact of the RBI draft norms on project financing? Is there any impact of that on your cost of borrowings? Do you expect that to rise?
No, we are a debt-free company, so that is not impacting us in any way. So we are a debt-free company. We are a low capex company. Our business model is that we are a consultancy company, and that's why, as you see, our return to shareholders have been high. 95% plus has been our dividend payout ratio for the last FY.
All right. We'll leave it there. So thank you very much for joining us, and it's a pleasure having you here on the program as always. That's the management of REITs. The market's down 100 points still, and I just want to take a quick look at what the market, the broader market is really doing. Market breadth is, I mean, actually largely 1:1, almost 1:1. So I'll start with what's up. Mazgaon was not there in the mix in the morning, but it is up about 3% or so right now. So 3128 on Mazgaon. Campus is up 12%. So, you know, it's basically piling on gains from, it started higher, but it's now up more. Jubilant Food, and we were talking about some of this QSR stuff. So 3 days back, stock was at about 450. It's moved up to about 515. So there is a little bit of buying which is going on here. Paras Defense is up about 6% at about 928, looking good. Sumitomo Chemicals, we mentioned. Moil is up 3.5%. And you got Concord Biotech. I saw an upgrade, I think, this morning, or maybe brokerage note, 7% on Concord Biotech after that block yesterday. JK Paper and Graphite and Exicom are some of the other names. Exicom is up about 6% or so at this stage. So that's the overall picture. Let's put the focus now on the next management. MedPlus Health Services is with us. They reported a good set for the fourth quarter. Revenues are up 19%, margins expanded as well. And the company added 174 stores in the last quarter. We'll discuss this and more with Mr. Gangadi Madhukar Reddy. He is Managing Director and CEO at MedPlus. Mr. Reddy, good morning, sir. Great to have you with us here. Appreciate your time. It's always a pleasure speaking with you. So let's just get the basic numbers out of the way before we dive into what is the state of competition, discounting, etc. So you did, 5,600 odd crores in sales in FY24. That was up some 23% year on year. For FY25, how's the landscape looking and what can you do?
A similar kind of growth is what I would expect, if nothing else happened, honestly. But yeah, it's a little early. Yeah.
So okay, but broadly at this point, sitting where you are, at least a 20% plus kind of growth, right?
Yeah, at least that much.
Okay.
And again, to get one more number out of the way, we'll most likely add another 600 odd stores to the 600 which we added last year. Yes.
Okay. And margins were 6.3% compared to 5.8. Would you keep that number 6% and more through in 25?
Absolutely. I don't see any reason for it to go down. It may not go up by too much. We will start getting benefit of scale and all as we go forward. But yeah, at least that much. And as we continue to increase our private label, I'm sure it'll get better. But yeah, I would say at least that much.
Okay. So what is the offtake of private label sales this quarter? I mean, what are you looking at? There's not been too much of a growth. I think Q4 private label sales were barely up about 1.1%. At some point, do you think you could get to high single-digit growth, and what's the view forward?
See, on the pharma side, our the net sales were around 8.5%. But you have to actually keep in mind that the current set of private label which we are selling is selling at a 45 to actually 55 to 60% discount, which means what we sold earlier at a 17% overall discount and where we are getting 83 rupees on a 100 rupee MRP, we're today getting only around 45. That still is profitable for us, but it has actually dropped the overall top line significantly. If you actually look at the, let us say the volume sales, GMV to GMV kind of stuff, in states like Tamil Nadu and all, where we are really focusing on by getting some advertisement in and all, we are seeing close to 16% sales overall. So this is a muted number because of the decreased top line, because of the discounts.
So how much do you want to increase the private label sales to as a percentage of overall sales? What are we looking at over the next 1 to 2 years?
For us, as I've been saying in the last 1 or 2 calls, the whole story in the pharma retail in India is now about genericization. Customers are realizing that the market basically sells a lot of Me Too products. Each product is made by, sometimes as many as 100 different companies, and there are several 100,000 brands out there. So people are realizing that, and people are seeing that, it's the same product, and they are willing to actually go with someone who can give them the right quality, and they will go with the best price, irrespective of the brand. So given that we are seeing the shift, both from the customer point of view, because there is more awareness and there's more, information out there, and given that the government is also pushing this very, very actively, I would think that that we should basically eventually be selling only private label and nothing else, honestly. But I don't know how fast the market will actually adopt. So I don't want to really speculate. I would say from the net sales of 8.5%, I would be surprised if we did not easily get into the low teens next year.
All right.
Sorry, Mr. Reddy, private label sales contribution is already about 15%, right?
I'm only talking about the pharma side.
Pharma, okay. But total pharma, non-pharma is about 15%.
It's about 15, yeah.
And what can this get up to? I mean, what would, as you said, you'd like to only, if ideally, but in terms of how this goes, what can this number get to?
Difficult for me to tell you that right now. I don't know how fast the market will actually adopt. But the thing is, there's zero reason for anyone to buy anything else, honestly. Given that the government is pushing it, I think it'll go fast. This year, as I said, okay, let me just talk the medicine numbers only. Out of 100 rupees which we sell, 80 is medicines. And 20% of that today, if you look at it by volume, is actually pharma. 19 to 20%. I would expect, going forward, this, over a period of time, this can easily double. Not this year for sure, but over a period of time, this can easily go up to double.
Okay, all right. Hi, Mr. Reddy. Good morning. We've got the total number of store addition that you're targeting, but give us a breakup as of now. How many are new and how many are mature stores?
Well, as of now, I think around 15% of stores are less than a year and around 40% of stores are less than 2 years. So, yeah, that would be the number out there. Yeah. What are the other breakups you want?
Got it. All right. And the margin number margin number that you're guiding for is more than 6%, but in quarter 4 to 7%. So on an average for the year, what will it be?
So for us, I'm only looking at the net EBITDA. I think, for the quarter 4, it was 4%. I'm not talking about the index number. I'm talking about the number which takes into account all the real estate and everything else. So I expect as we go forward, because of scale and everything else, we should continue to add 0.5% to 1% over a period of 1 year.
Okay.
Given that we are only around 600 stores this year.
Okay. I wanted your thoughts also on the diagnostics business. I think you announced that you are going to defer your plans to expand your diagnostics business. Why is that? And because earlier you had some plans to, take that business forward. But are you seeing a slowdown there? Is there a lot of competition there? Can you just give us a sense of how things are playing out?
No, it is not because of competition. Yes, definitely we want to actually take a pause and basically consolidate our story in Hyderabad only right now. See, as I have said in the past, it's a new model. It is based completely on subscription. The model is extremely sensitive to the number of subscribers. Once you have set up the network, spent the money, the more number of people you have subscribing and paying you the 1,000 or 1,500 rupees a year, the more profitable you are. There's a certain level though below which you are not. So let us say at 250,000 members we are breaking even and making money. At 500 we'd be, it'll be out of the park. But we are still there at the 140,000 number odd. So the proof is still not yet there. B2C we're doing very well. B2B we're not doing as well. So the focus will be on trying to get more customers to the B2B side, crossing that 250,000 number before we take a call and further expansion.
So you're at 140,000 currently. By when? Any kind of indicative timeline on when you plan to reach or when you can achieve that 250,000 number?
So on the B2C side, it's a slower growth. We have already hit the numbers we want to. We're basically operating through our 12 diagnostic centers, and we are also getting members through our 440 odd stores in Hyderabad. I don't think that's going to go up very significantly. We may add net 5 or 10,000 every month. 5,000 maybe every month is what we'd add. But the B2B, on the other hand, if you actually get the right kind of customers, coming in, you could add 5, 10, 15, 20,000 also every month. So given that we are focused only on B2B this side, and given that the sales cycle on that is much longer and slightly unpredictable, I could not tell you exactly when. But if B2B doesn't happen, then we'll probably end the year with maybe around 175 to 200,000.
Okay. Mr. Reddy, just one point. You said that private labels and so the government is also pushing this. So you're talking about on the medicines, pharma side, you're talking about branded generics, right? That's what you're largely sort of referring to in terms of a government push as well?
There are only two types of medicines. Either it's patented or not patented. If it is not patented, no matter what name you put out there, it is a generic.
No, that's fine. But branded generic, I mean, you kind of add that is what you've been sort of bullish on as well, right? You're trying to sort of increase the sales there. My only question is, that is what you were referring to. I just wanted to confirm that. And if that is, would this require sort of, a little bit more in terms of awareness if this has to really take hold? Because I'm assuming for the vast majority of people that go with, even for a simple medicine for headache, you'd go with, you'd ask for a brand, right? So when we're talking about sort of branded generics in that sense, I remember having this conversation with you last time as well. Would this require a little bit of spend on advertising, awareness, etc.? Go on.
We are doing that a little bit. Last quarter, we ended up actually spending around 10 crores. And we have spent it mostly in Tamil Nadu and all. And that has actually shown us good results. Today, 20% of all the medicines we sell in Tamil Nadu are our brand, MedPlus brand. So absolutely, we have to increase the awareness and all. Now, to come to the second thing, yes, people who actually buy medicines one-off and people who buy them for, let's say, headache or pain or some antibiotic kind of thing, small infection, will most likely go with brands. Mainly because the doctor has told them they're not going to go do research for a little bit, decrease in price. Mainly because it is not a continuing spend. It doesn't really hurt them too much. But chronic, customers who buy 1,000 to 3,000 or 4,000 worth of medicines month on month every year, they are the ones who we appeal to. They are the ones who will go and do the research. They're very, very price sensitive, obviously. And some of them get converted and basically start buying it. And the more people buy, the bigger the, I would say the spread of word of mouth.
No, I get that. We'll leave it there, sir. Thank you very much and good luck with your plans on this one and, of course, overall business as well. Look forward to speaking with you soon again. But good conversation. That's MedPlus with what they're doing out there on the private labels, on the branded generic side, and, of course, overall. So 20% growth in FY25 revenues. Margin should be north of 6%. That's the aim for 25. Markets are still down about, 80 odd points or so. Let's sort of focus on the market a little bit. We have Sachidanand Utekar, AVP Technical Equity at Trade Bulls, joining us now. Sachidanand, great to have you with us here as always. Thanks for your time. I mean, this is just sort of in a bit of a holding pattern ahead of the election results. Would you look at it like that? Or would you take away anything more meaningful from the price action today and, of course, the sell-off that we saw in the last hour yesterday?
Good morning, Prashant. Yesterday we saw the Nifty, sliding back to its 5-day exponential moving average support, which is placed somewhere close to around 22,830. I think this particular level becomes a very key, important, pivotal, level for revival. So I think the way the data is placed, 22,700 looks like a dependable support. We've already seen a swing towards 72,750. And I think the reversal is quite meaningful, and we may see some more traction once the Nifty starts trending confidently above that 22,830 mark. So I think once the Nifty clears this particular level, then we may see an extension towards 22,930 during the day itself. So I think for the day, at least, there has been a meaningful support, and I think this particular support, may remain stable throughout the day. We may see a good, strong recovery in the second half, and we are expecting the expiries for the Nifty Bank at least to scale somewhere close to around 48,900, 49,000 itself. So I think both the indices have seen an intraday dip, and probably for the day, the low seems to be established, and we may see a sustainable recovery from here on.
Okay, well, individual stocks, what are you looking at this morning, Sachidanand?
Two stock ideas. First of all, we have recommended this to our clients as well. Adani Enterprises is displaying a piercing line formation on its daily scale after 3 days of a consecutive decline. We have seen a very strong recovery here. We are expecting that this particular momentum may stretch towards 33.05 during the day, and probably see an extension towards 3360. And that's why we are still comfortable recommending building long positions here. The stop loss from here on should be placed somewhere close to around 32.30 on the lower side. And the other stock which has hit our radar is Asian Paints. Now the stock was consolidating near to that 2900, 2880 kind of a zone. And in the morning, we have seen a good sustainable breakout above that particular level. So we are expecting that there could be a good recovery in the stock. We may see a good pullback rally towards 2960, and that's why we are recommending building long positions here, keeping a stop loss somewhere close to around 2910.
All right, Sachidanand, we'll leave it there. Good conversation. Thank you very much, and we'll have you back during the course of the day. For more, we'll take a break. Markets down three digits again, 100 points lower on the Nifty. Manisha will be joining in with a roundup of all things commodities on the other side. Stay tuned.
Okay, so for now, the market is still down. So it could go either way, actually. The Nifty is down about 130 odd points. The Bank Nifty is the one that's feeling the heat, maximum amount of heat, actually. Down almost 430 points on the Bank Nifty. And the mid-cap index, from being flat, it's taken a turn for the worse. So not looking good. The last 15-20 minutes actually have aggravated the pain in the market. The top losers today are some of the life insurance companies. HDFC Life, SBI Life are the big losers. Axis Bank, ICICI Bank, HDFC Bank. So financials actually are dragging their feet this morning. Let's see, the day is long, but for now not looking that good for the market. But let's focus to the commodity space now. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Thank you for that, Sonia. I'm looking at the crude oil prices because we're looking at good gains onto this one. Last week wasn't so great. We saw 3.5% of a decline, but with the kind of surge that we're looking at right now at 84.5, it's a 4-week highs in case of the crude oil prices. It is also about the summer season demand in US. That seems to be picking up. There are some initial preliminary reports which suggest that the US summer season driving demand could be the highest in last couple of decades. And then there is premium coming back from the renewed geopolitical unrest in West Asia. There is fighting that has escalated is between Israel and Gaza. That seems to be adding to the prices there. The markets are concerned about more uncertainty within the Middle East, and that is what is worrying the supplies in sense of crude oil there. There also are reports of yet another vessel in Red Sea being attacked, and that also the details of that are still awaited within reports, but that is also something that is bothering the crude oil markets there. The US inventory data is today, and for the last 3 weeks, weeks, we've seen constant decline in US inventories, also a decline in gasoline and distillate inventories, and that has been supportive. The markets also are looking at the OPEC crude exports for between 1st to 19th of May, and there has been a decline onto that one. They are the lowest since August 2023. So within OPEC as well, we are looking at a higher amount of agreement and compilation of that as well. If you look at the prices for Brent crude until now in this year, which started quite on the lower side at around $75. 91 has been the high for 2024 until now. We did see prices go down to 80 as well, but 84 is where we are trading at this point in time. Interesting cues coming in from the global crude demand as well, and those numbers are something that the street is looking for right now. In 2023, an average global demand was 101.9 million barrels per day. In this year, first quarter has seen a rise on that and 102. If you look at just the month of May until now, the demand has further increased to 103 million barrels per day in sense of global markets there. The demand also comes in on the back of from US in sense of Europe and in Asia as well, where we are looking at stronger numbers here. Now, this is the growth forecast estimates coming in from major agencies and the banks as well. The highest expectation clearly from OPEC at 2.2 million barrels per day, but anywhere between 1.1 to 1.7 million barrels per day of an incremental demand growth is what the street is anticipating. UBS, JP Morgan, Stancy, Goldman Sachs, IEA, all of them anticipate a higher demand globally as compared to the previous year there. Interestingly, also, there's a report from Goldman Sachs which says that the crude oil demand would not peak before 2034 and would continue to plateau until 2040. That in turn also tells you that the investment in crude in sector has been lower, and that would continue to support the prices going forward.
Okay, all right, Manisha, thanks a lot for that. Well, let's focus on a few stocks that are bobbing around in trade today. Mangalam joins us to tell us about IRCTC. The stock is under some pressure. Mangalam?
Yes, so IRCTC, while the revenues for the company this time around were good, it was the operational miss that has the stock lower in today's trading session. And the biggest one actually has come in from their key segment, which is the internet ticketing segment as well. So just to run you through the numbers, year on year, while IRCTC saw a revenue growth of around 19.7%, around 1155 crores, the EBITDA grew just around 11.7%, telling you that there was a margin dip reported by the company of around 220 basis points. The net profit was largely flat. That's because of an exceptional gain in the base quarter. But that, if you adjust for, would have grown in high single digits itself. The key segment of the company, internet ticketing out there, the revenues grew 16%, but the EBIT grew just around 5.8%, telling you that margins, which are earlier anywhere between 85 to 90%, have come all the way down to 80% itself. So there's an 800 basis points decline out there, and that's led to the overall margin miss. And also the catering business, as the operations pick up, the expenses also pick up, and as a result of which their margins come off. 34% revenue growth in the catering business has not resulted in any EBIT growth. In fact, EBIT has declined by about 3% year on year, and that implies that the margins have compressed out there by over 350 basis points as well. So all of this is something that the street does not like. Despite the revenues growing, that not reflecting in the bottom line is something that the street is taking note of, and the stock is down 4.5% on account of that.
Okay, thanks for that. But Campus Activewear is the other one which is looking really good. Mangalam, what's going on there?
Well, good operational performance out there. The revenues have picked up, yes, 4.6%, led by about 4% volume growth. Nothing really to write home about out there. There's mild improvement. But look at the EBIT. The EBITDA has grown by about 13%, margin improvement of around 130 basis points, and that's flowed all the way down to the bottom line, which has seen a growth of nearly 40%. What the company said is that it was their renewed focus on trade distribution that led to the margin growth and the revenue growth in the second half of this year. They've also, generated more cash, and as a result of which, even in a tough year, they've become net debt free by paying about 156 crore of debt, and they've reduced their working capital days from 108 to about 79. Kotak's actually written on Campus this morning as well, and they've said that these numbers were a beat on profitability. The company saw a 7.5% growth in their multi-brand outlet channel, and the management, according to them, is confident of reverting to double-digit revenue growth with EBITDA margins between 17 to 19%, as a result of which they maintain their ad rating with a target price of 285 on the stock.
All right. Thanks very much, Mangalam, for that. Well, Sudarshan is here to put the focus on a whole host of companies which are reacting to their earnings. Over to you.
So I'll start with companies which have reported weak earnings. First one is Engineers India. Profit has fallen 39%, EBITDA is down 54%, and margin has slipped almost 1,000 bips against the same quarter last year. And its biggest contributor to total revenue, that is consultancy and engineering projects, and its EBIT has halved to 96 crore. Next one is MTR Tech. It has reported very weak earnings. EBITDA has fallen 63% and margin is down more than 1100 bips against the same quarter last year. But company says it has registered lower than estimated EBITDA in FY24 because of operating leverage was lower due to deferment of orders. But for FY25, company says it's targeting to achieve revenue growth of 30 to 35%, and that's increase against FY24. Last one is NBCC. It has reported a strong set of earnings for Q4 and led by PMC segments. EBITDA was up 130%. Margin has increased more than 200 bips year on year. Project management consultancy, which forms 91% of revenue in the Q4, and this one's revenue has increased more than 47% YOY to almost rupees 3,700 crores.
Okay, all right. So, Darshan, thanks a lot for that. Well, I'm focusing on Hindalco. That's the one that we're looking at because ahead of that Novelis IPO, they've come out with a few more details. So, the price range has been fixed at around $18 to $21 per share, which means that the total dilution that they're going to be doing for this 45 million shares is around 7.5%. For this, Hindalco, since they're diluting 7.5% stake, they'll receive roughly around 6,700 to around 7,800 crores, depending on the price that you're working with. Valuation-wise, an equity valuation will be around $10.8 to around $12.6 billion. But you pull in that $4.3 billion of debt, and the total valuation is roughly around $15 to around $17 billion. Now, what does it mean? At these prices that they've come out with, you know, the IPO will be priced at around 7.2 to around 8 times EV per EBITDA. Some on the street are in that vicinity of around 6 to around 6.5 to around 7 times for Novelis. So in those terms, well, they're getting a bit of a premium. So that's good news. But we'll need to know what is Hindalco going to do with the 6,500 to around 8,000 crores that they will get. In all probability, it's likely to be used for capex here in India. And the good news is now Vodafone Idea is fully capitalized for the next couple of years. So no fear with regard to any money going over there. Now, post-listing, what's the problem for Hindalco from a shareholder's perspective? There could be a holding company discount that will be assigned to the stake that they have in Novelis. That's point number one. Second factor is a fourth of their shareholding is FIs. And some of those FIs that are playing it for Novelis will go directly and take exposure in Novelis since it will be listed as well. What are brokerages making of it? JPM as well as CLSA, both of them are quite positive on the stock with the target price in excess of 750 rupees odd. Well, for the time being, we'll slip into a short break. On the other side, we'll be joined by Mr. Ravi Jajkar, the Chief Strategy Officer of All Cargo Logistics. Stay with us.
Okay, welcome back. You got the market, which is under pressure. All Cargo Logistics is the company that we're now talking to. Margins were impacted by one-off severance costs, and EBITDA slipped by some 31% on a year-on-year basis. But will there be better performance into the new year, FY25? We have Ravi Jajkar, Chief Strategy Officer at All Cargo Logistics, joining us to take some questions. Great to have you with us here, Ravi. Prashant this side. Thanks for joining in. So it's been a tough year, right, overall for the business. Revenues for the full year are down 27%. EBITDA is down some, 60%. What should we expect in FY25? If you can give us an overall sort of headline picture in terms of a guidance, and then we can get into the individual segments for you.
Yeah, so I think, in our business, revenue is more of a derivative of ocean freight rates and therefore relatively less relevant. We had seen the first half of calendar year 2023, which was doing okay, and then the markets and the macroeconomic environment worsened. However, if you look at the last 2-3 quarters, the performance has flattened out, and the decline which was happening previously has already been arrested. This quarter, quarter 4, FY24 has also been flattish compared to FY24 quarter 3. Now, as we move forward, there are 3 businesses that we operate in. The international supply chain business is clearly seeing the rebound that we have been estimating, and we've been looking at second half of 2024 calendar year to be stronger in terms of demand, and we already see green shoots now. We notice that on several trade lanes, we are already seeing ocean freights rise on account of increased demand, and that means that we should see improved container utilization, and that should mean increased volumes as well as improved margins in the second half of calendar year 2024. So that's something which is looking good on the international supply chain business. On the business side, we have always been very strong, both operationally as well as from a technology standpoint. And it was largely an outcome of macroeconomic environment, which was challenging over the last 3 to 4 quarters, but that's now clearly looking up. On the domestic side, the macroeconomic environment has remained buoyant, and the challenges were more internal as we were trying to turn around the express business. And I'm glad that we have achieved what we wanted to. If you look at the express business, the costs have been reduced by almost 7% on a cost per kg basis. And a large part of that is the last quarter of the year gone by. And if you look at the March exit rates, with 7% lower costs, it has translated into improved gross profit, which is 15% higher, improved EBITDA, which is almost 115% higher sequentially. And as we look ahead, the international supply chain business would see sequentially improving performance quarter on quarter on account of revival in macroeconomic environment. And the express business would see sequential improvement on account of, all the cost reductions which have already been achieved. So from here on, we estimate that the quarters going forward should look better. Contract logistics business remains as stable as it has always been.
Can you put a number to it, Ravi? Is that possible overall?
So I would not put a number in terms of guidance, but like I said, every sequential quarter should be better from here on, and that's been our guidance for the last few quarters.
Supply chain and the express business.
Yes, for the international as well as the domestic business, both businesses.
Okay. Ravi, hi, good morning. Just a couple of more questions. In severance costs, you had said that severance costs will get concluded by August, right? Are we on track with that, and how much more is left?
Yes, we are absolutely on track with that. We have been reducing costs, and that, of course, is a impact on the severance as well. I would say this quarter has possibly seen maybe about $1.5 million overall in severance costs and other one-off cost impacts. Now, as you move into the next quarter, while there will be some severance costs with notices running into July, August, there would also be savings emanating from numbers already reduced in the quarter gone by. So I don't see major significant impact of severance costs in, say, the first quarter of FY25, maybe $500,000 here or there, not more than that. And second quarter should largely have no impact. And the cost reduction initiative should basically help us take care of all the escalations in staff costs on account of inflationary increases. And that means that despite all the headline inflation numbers being very high across global economies, we should be able to contain our SG&A cost. And that means that the entire gain in gross profits should go down to the bottom line. And that's the intent. And that's how we expect our margins to improve in the second half of the year.
So in terms of containing your SG&A costs, right, what's the total cost reduction? If you can give me that one number, how much are you going to reduce costs further by, and what is the impact it would have on your margins?
So various initiatives that we have taken, across both in staff and general administrative expenses are in the range of about $25 to $30 million. And if you look at our total SG&A cost, which is north of $200 million, this means that any annual increments and all will be taken care of through these reductions. So that's the kind of impact. Basically, I'm talking about a $25 to $30 million initiatives, which should allow us to completely offset all global increases, which would be otherwise standard in business. And that means that any expansion in business on account of volumes, improved utilization, all of that should come down to bottom line. And that's been the plan all through. And we should see the impact from July onwards on that count.
Ravi, so then, just give us a broad ballpark sort of idea. So margins were about 3.5% for the year gone by. What can this get up to as the business momentum picks up on both sides, all these cost reduction initiatives? Is there an upward bias, and where the ballpark?
So I would say that, in terms of the EBITDA margins, on a volume basis, could potentially see up to 50% increase from here. It is not appropriate to look at the percentage margins because revenue is, a derivative of ocean freight rates, like I mentioned. The primary driver in this business is how well your container is utilized. And today, to share an example,
so if you can,
trade lanes from
is it better
Asia
to look at
South
EBIT?
America.
Is it better to look at instead of the percentage number, EBIT per TEU? Is that a better metric?
So there are two parts of the business. One, which is full container loads, which go in TEUs, and the second one, which is LCL, which is in cubic meters. So overall, one is EBIT per TEU, and the second is EBIT per CBM. Of course, we get the combined number. I would expect that EBIT per TEU as well as EBIT per CBM should be ballpark growing in the same range. And therefore, as we expand the volumes and the profit margins improve, there should be an outcome of, up to 40 to 50% kind of uptick should be possible from here.
Okay, all right. We will let you go on that note. Ravi, thanks a lot for joining in. Appreciate your time here. That's all cargo logistics. But for the market, it's actually gotten worse. So don't lose sight of that. The Nifty is now down about 160 points. The sensex is down about 530 points. So yes, there is definitely some trepidation ahead of the election verdict. The exit polls are on Saturday. So ahead of that, there is definitely some trepidation in the market. The bank Nifty is down about 500 points. But from the entire team at Bazaar, thanks a lot for watching. Chartbusters up next. Stay tuned for that.